9. Optimizing trading strategies with Bayesian optimization. Optimizing the parameters of a quantitative trading strategy is a critical step in enhancing its performance and robustness. A strategy's profitability often hinges on a few key parameters. For instance, the look-back periods for moving averages, the standard deviation multiplier for Bollinger Bands, or the threshold for an RSI indicator. Finding the optimal combination of these parameters can significantly improve a strategy's risk-adjusted returns. The challenge of strategy optimization. Traditional methods for parameter optimization, such as grid search and random search, face significant limitations when applied to complex financial trading strategies. Grid search. This method evaluates the objective function, e.g., Sharpe ratio from a backtest, at every point in a predefined grid of parameter values. While exhaustive, it becomes computationally prohibitive very quickly as the number of parameters or the granularity of the search space increases. 4 code snippet parameters, each with code snippet possible values. Grid search requires code snippet evaluations. Random search. This approach randomly samples parameter combinations from the search space. It is generally more efficient than grid search for high-dimensional spaces, as it's more likely to find a good combination within a given number of evaluations. However, it still relies on chance and doesn't learn from past evaluations to guide future searches. Both grid search and random search treat each evaluation as an independent event. They do not leverage information from previous backtest results to intelligently select the next set of parameters to test. This blind approach is particularly inefficient when the objective function, our backtest, is expensive to evaluate. Running a full backtest could take seconds, minutes, or even hours, especially for complex strategies or large datasets. Noisy. Financial markets are inherently noisy. The performance of a strategy with specific parameters might vary slightly even with the same historical data due to minor data fluctuations or backtesting engine nuances. Nonconvex. The relationship between strategy parameters and performance metrics is rarely a simple, smooth curve. There can be multiple local optima, making it hard to find a global best. Bayesian optimization offers a sophisticated solution to these challenges. It is a model-based optimization technique that efficiently searches for the global optimum of expensive, noisy, black box functions. Unlike grid or random search, Bayesian optimization uses past evaluation results to intelligently decide which parameter combination to try next, aiming to minimize the number of expensive backtest runs needed. Core principles of Bayesian optimization. Bayesian optimization operates on an iterative process, continuously refining its understanding of the objective function. 1. Initial samples, a small number of parameter combinations are chosen randomly and evaluated, i.e., backtested. 2. Build/update surrogate model. Based on these initial and subsequent evaluations, a probabilistic surrogate model is constructed. This model approximates the true, expensive objective function and provides both a prediction of the objective value and the uncertainty around that prediction. 3. Select next point. An acquisition function uses the surrogate model's predictions, mean, and uncertainty to determine the next most promising parameter combination to evaluate. This step balances exploring unknown regions of the search space with exploiting regions believed to contain good solutions. 4. Evaluate objective function. The selected parameter combination is fed into the actual, expensive objective function, e.g., running a backtest. 5. Repeat. The new observation, parameters and their performance, is added to the set of evaluated points, and the process returns to step 2, updating the surrogate model. This iterative learning process allows Bayesian optimization to converge on optimal parameters much faster than brute force methods, making it ideal for financial strategy optimization. Key components of Bayesian optimization. To understand how Bayesian optimization works, it's essential to grasp its 2 primary components, the probabilistic surrogate model and the acquisition function. The probabilistic surrogate model. At its heart, Bayesian optimization avoids directly evaluating the expensive objective function repeatedly by building a cheaper-to-evaluate approximation called a surrogate model. What it is: the surrogate model is a statistical model that learns the relationship between the input parameters and the output performance metric from the limited number of actual objective function evaluations. It acts as a proxy for the true, expensive function. Why? Probabilistic. Unlike a simple regression model, a probabilistic surrogate model doesn't just provide a single prediction, mean, for a given set of parameters. Crucially, it also quantifies the uncertainty or variance around that prediction. This uncertainty is vital for guiding the search. Areas where the model is uncertain indicate regions that need more exploration. Common types: Gaussian processes, GPs. These are the most common choice for the surrogate model in Bayesian optimization. GPs define a probability distribution over functions, allowing them to provide both a mean prediction and a confidence interval, variance, for any given input. They are flexible and excel at modeling complex, nonlinear relationships. Random forests or tree parson estimators, TP. Other models can also be used as surrogates, particularly for higher dimensional problems where GPs can become computationally intensive. These are often used in libraries like hyperopt. How it's formed and updated. Initially, the model is trained on a small set of randomly sampled parameter performance pairs. As new parameter combinations are evaluated by the actual objective function, these new data points are added to the training set, and the surrogate model is retrained or updated. This continuous refinement makes the model's predictions more accurate over time. The acquisition function. The acquisition function is the strategy's brain. It uses the predictions, mean and variance, from the probabilistic surrogate model to decide where to sample next. Its primary role is to balance two competing objectives. Exploitation, sampling points where the surrogate model predicts a high objective value, i.e., exploiting regions known to be good. Exploration, sampling points where the surrogate model is highly uncertain, even if the predicted mean is not currently the highest. This helps discover potentially better regions that the model hasn't accurately mapped yet. By balancing exploration and exploitation, the acquisition function ensures that the optimizer efficiently moves towards the global optimum while avoiding getting stuck in local optima. How it works. The acquisition function takes the current surrogate model as input and outputs a score for every possible point in the search space. The optimizer then selects the parameter combination that maximizes this acquisition function score as the next point to evaluate with a true objective function. Common types. Expected improvement. This is one of the most popular acquisition functions. It quantifies the expected gain over the current best observer. Vet objective value. It favors points that are likely to yield a significant improvement, considering both the predicted mean and the uncertainty. Upper confidence bound. UCB selects the point that maximizes code snippet, where code snippet is the predicted objective value. Code snippet is the predicted uncertainty, and code snippet is a tunable parameter that controls the balance between exploration and exploitation. A higher code snippet encourages more exploration. Probability of improvement. PI is simpler acquisition function that calculates the probability that a new sample will improve upon the current best. While intuitive, it can be overly greedy and less robust to noise than EI or UCB. Practical application. Optimizing a simple moving average, SMA, crossover strategy. Let's walk through a conceptual and then a code-based example of optimizing a simple SMA crossover strategy using Bayesian optimization. Our goal will be to find the optimal code snippet and code snippet periods that maximize the strategy's Sharpe ratio. 1. Setting up the trading strategy, objective function. The core of our optimization is the code snippet that Bayesian optimization will call. This function encapsulates our trading strategy and backtesting logic. It takes the parameters we want to optimize as input and returns the performance metric we want to maximize or minimize. For demonstration, we'll use a simplified code snippet function. In a real-world scenario, this would be a comprehensive backtesting engine that accounts for slippage, commissions, position sizing, etc. Download the code on OnePageCode Substack. The code snippet function is our black box objective function. It takes two integer parameters, code snippet, and a code snippet series, then computes a Sharpe ratio. This function is considered expensive because, in a real scenario, it would involve loading historical data, performing calculations, and potentially simulating trades over a long period. Returning code snippet for invalid parameter combinations or non-viable strategies is a common practice to guide the optimizer away from such regions. 2. Defining the search space. Before running the optimization, we need to define the permissible range for each parameter. This is known as the search space or bounds. Download the code on OnePageCode Substack. The code snippet dictionary specifies the lower and upper bounds for each parameter. Bayesian optimization will explore values within these ranges. It's crucial to define realistic and meaningful bounds based on domain knowledge. For instance, a code snippet of 1 or a code snippet of 1,000 might not be practical for daily stock data. 3. Initializing the Bayesian optimizer. We'll use the code snippet library, a popular Python package for implementing Bayesian optimization. We need to instantiate the code snippet class, providing it with our objective function and the defined parameter bounds. Download the code on OnePageCode Substack. The code snippet wrapper function is important because code snippet typically passes float values to the objective function, even if integer parameters are desired. We cast them to code snippet before passing them to code snippet. The code snippet parameter ensures that the initial random points chosen by the optimizer are the same every time you run the code, which is crucial for reproducible research. 4. Running the optimization. Once initialized, we simply call the code snippet method of the optimizer. This method orchestrates the iterative process of building the surrogate model, selecting points, and evaluating the objective function. Download the code on OnePageCode Substack. Code snippet determines how many initial random samples are taken before the Bayesian process begins. These initial samples are crucial for the surrogate model to get a preliminary understanding of the objective function landscape. Code snippet specifies how many times the core Bayesian optimization loop, update model, select point, evaluate will run. A higher code snippet generally leads to a more thorough search, but requires more expensive objective function evaluations. 5. Accessing results. After the optimization completes, the code snippet object holds all the results, including the best parameters found and the corresponding objective value. Download the code on OnePageCode Substack. The code snippet attribute provides a dictionary with the code snippet, the parameter combination that yielded the best result, and the code snippet, the corresponding objective value, in our case, the Sharpe ratio. It's good practice to convert the float parameters provided by the optimizer back to integers if your strategy requires them. The code snippet attribute contains a list of all evaluated points during the optimization process, which can be useful for analysis. Advantages and considerations. Advantages of Bayesian optimization for trading strategies. Efficiency requires significantly fewer objective function evaluations compared to grid or random search, leading to faster optimization times, especially for expensive backtests. Handles noisy and nonconvex functions. Its probabilistic nature allows it to effectively model and optimize functions that are noisy, have multiple local optima, or are non-smooth, which is common in financial strategy performance landscapes. Global optimization tendency. By balancing exploration and exploitation, it is more likely to find the true global optimum rather than getting stuck in local optima. Automated tuning reduces the manual effort and guesswork involved in finding optimal parameters. Considerations and limitations. Choice of surrogate model and acquisition function. While Gaussian processes and expected improvement are common, their performance can vary depending on the problem. For very high-dimensional parameter spaces, GPs can become computationally expensive, and alternative surrogate models like TP might be more suitable. Defining search bounds. The quality of the optimization heavily depends on well-defined parameter bounds. Too narrow, and you might miss the optimum. Too wide, and the search becomes less efficient. Local optima. While better than naive methods, Bayesian optimization is not guaranteed to find the global optimum, especially if the code snippet are poor or the code snippet is too low for a very complex objective function. Computational overhead. While it reduces the number of objective function calls, updating the surrogate model, especially GPs, can introduce its own computational cost, which might be noticeable for very large numbers of iterations or high-dimensional problems. Scalability. For problems with many, e.g., greater than 20 parameters, Bayesian optimization can still become challenging due to the curse of dimensionality affecting the surrogate model. Despite these considerations, Bayesian optimization remains a powerful tool for systematically and efficiently tuning the parameters of quantitative trading strategies, leading to improved performance and more robust models. Optimizing trading strategies. Optimizing a quantitative trading strategy is the process of systematically finding the best set of parameters that yield the desired performance characteristics for that strategy. Unlike discretionary trading, where decisions are often qualitative, quantitative strategies rely on predefined rules and mathematical models. The effectiveness of these rules is highly dependent on the numerical values assigned to their constituent parts, known as parameters. Understanding strategy parameters. Parameters are adjustable inputs that control the behavior of a trading strategy. They are the knobs and dials that fine-tune how and when a strategy generates signals, manages positions, or calculates risk. The choice of these parameters can dramatically alter a strategy's profitability, risk profile, and overall robustness. Consider a simple moving average, MA, crossover strategy, a foundational concept in technical analysis. This strategy typically generates a buy signal when a shorter period moving average crosses above a longer period moving average, and a sell signal when a shorter MA crosses below the longer MA. For such a strategy, the key parameters are the code snippet for the fast moving average, e.g., 10 days. The code snippet for the slow moving average, e.g., 50 days. Let's illustrate how these parameters would be integrated into a conceptual strategy framework. Download the code on OnePageCode Substack. In this initial conceptual structure, code snippet and code snippet are clearly defined as the parameters that will be subject to optimization. The code snippet method uses these parameters to compute the actual trading signals. Other strategies might involve different types of parameters. Relative strength index, RSI, strategy, code snippet, code snippet, code snippet. Bollinger Band strategy, code snippet, code snippet. Pairs trading strategy, code snippet for co-integration test, code snippet, code snippet. Defining the search space. The search space, or parameter space, is a set of all possible values that each parameter can take. For optimization, we need to define the permissible range or discrete choices for each parameter. Parameters can be discrete, taking specific countable values, e.g., code snippet can be 5, 10, 15, but not 5.5. Continuous, taking any value within a given range, e.g., a volatility threshold could be 0.01, 0.015, 0.0157, etc. Defining the search space is crucial because it directly impacts the complexity of the optimization problem. A wider or denser search space will generally require more computational effort. Download the code on OnePageCode Substack. Here, we explicitly define code snippet and code snippet as lists of discrete integers. These lists represent the potential values our optimization algorithm will explore. The objective function. To determine which set of parameters is best, we need a quantitative measure of a strategy's performance. This measure is called the objective function or fitness function. The goal of optimization is to find parameters that maximize or minimize this function. Common objective functions in quantitative trading include net profit/terminal wealth, the total profit generated by the strategy over the backtesting period. While intuitive, it doesn't account for risk. Sharpe ratio measures risk-adjusted return. It's the average return earned in excess of the risk-free rate per unit of total risk, standard deviation. Higher is better. Sortino ratio, similar to Sharpe, but only considers downside deviation, bad volatility, making it a preferred metric for some traders. Higher is better. Kalmar ratio, measures return relative to maximum drawdown. Higher is better. Maximum drawdown, the largest peak-to-trough decline during a specific period. This is often minimized. Profit factor, the ratio of gross profits to gross losses. Higher is better. A robust objective function often combines multiple criteria or heavily penalizes undesirable outcomes like large drawdowns. Download the code on OnePageCode Substack. This code snippet conceptually ties together the strategy, its parameters, and the performance measurement. In a real-world scenario, the backtesting step, lines 48 to 52, will be a much more complex and robust simulation, accounting for transaction costs, slippage, and position sizing. The limitations of manual tuning. Historically, traders might have manually adjusted par. Amateurs running backtests repeatedly to see the impact. This approach is highly inefficient and prone to human bias. Time-consuming. Each parameter combination requires a separate backtest. Suboptimal results. It's easy to miss the truly optimal parameters in a vast search space. Human bias. Traders might stop searching once they find a good enough combination or be influenced by recent market performance. The limitations of exhaustive search, grid search. To overcome manual tuning, grid search was an early automated approach. It involves defining a discrete set of values for each parameter and then testing every single possible combination of these values. While systematic, grid search quickly becomes infeasible as the number of parameters or the range of their values increases. This phenomenon is known as the curse of dimensionality. Let's quantify the computational expense. If we have two parameters, code snippet, and each can take 10 discrete values, there are $10 times 10 equals $100 combinations. If each backtest takes 1 second, that's 100 seconds. Manageable. Now, imagine a strategy with 5 parameters, and each can take 20 different values. The number of combinations explodes. $20 equals 3,200,000 combinations. If each backtest still takes 1 second, this would require $200,000 seconds, which is approximately $37 days of continuous computation. $3,200,000 text seconds /60 text seconds /minute times 60 text minutes /hour times 24 text h r/day approximate 37.04 text days $. This makes grid search impractical for strategies with more than a few parameters or when fine-tuning parameter values. Download the code on OnePageCode Substack. This conceptual code snippet function demonstrates the brute force nature of grid search. It systematically checks every defined point in the parameter grid. Limitations of random search. Random search offers a partial improvement over grid search for high-dimensional problems. Instead of evaluating every point on a fixed grid, it samples parameter combinations randomly from the defined search space. Surprisingly, for many optimization problems, random search can find better solutions than grid search in the same amount of time, especially when only a few parameters significantly impact performance. However, it still relies on chance and doesn't learn from past evaluations, meaning it can waste evaluations on unpromising regions of the search space. The critical need for automated, model-based optimization. Given the limitations of manual tuning, grid search, and random search, modern quantitative trading relies heavily on advanced automated optimization techniques. These methods are designed to 1. Efficiently explore the search space, focusing computational resources on promising areas. 2. Find near-optimal or optimal parameters, even in complex, high-dimensional spaces. 3. Automate the process, reducing human intervention and bias. This is where techniques like Bayesian and optimization come into play. Unlike grid or random search, Bayesian optimization builds a probabilistic model of the objective function and uses this model to intelligently decide which parameter combinations to evaluate next. This learn-as-you-go approach makes it significantly more efficient, especially when evaluating the objective function, i.e., running a backtest, is computationally expensive. Download the code on OnePageCode Substack. The code snippet function, even with its simplified random sampling for illustrative purposes, highlights the critical inputs to a sophisticated optimizer: the strategy's objective function, the defined parameter search space, and a budget for evaluations. The actual power of Bayesian optimization lies in how it intelligently selects code snippet based on a surrogate model and acquisition function, rather than randomly or exhaustively. Overfitting and robustness. A critical pitfall in parameter optimization is overfitting. This occurs when a strategy's parameters are tuned so precisely to a specific historical dataset that they perform exceptionally well on that data, but poorly on new, unseen data out of sample data. It's like memorizing answers to a test rather than understanding the concepts. To mitigate overfitting and ensure robustness, several best practices are employed. Out-of-sample testing. Always test the optimized parameters on a period of data that was not used during the optimization process. This provides a more realistic assessment of future performance. Walk-forward optimization. Instead of optimizing once on a large historical dataset, the optimization is performed iteratively on rolling windows of data, and the best parameters are applied to the next out-of-sample period. This helps the strategy adapt to changing market conditions. Multiple objective functions / constraints. Instead of optimizing for a single metric like net profit, consider multi-objective optimization, e.g., maximizing Sharpe ratio while minimizing maximum drawdown, or applying strict constraints on risk metrics. Parameter stability. Look for parameter sets that provide good performance across a range of values, rather than a single sharp peak in the objective function. This indicates a more stable and robust strategy. The aim is not just to find the best parameters for the past, but the most robust parameters that are likely to perform well in the future, adapting to various market regimes and unforeseen events. This focus on robustness is a cornerstone of developing sustainable quantitative trading strategies. Parametric trading strategies. Trading strategies, at their core, are sets of rules designed to generate profits from market movements. Many of these strategies are parametric, meaning their behavior and performance are significantly influenced by a set of adjustable numerical inputs, known as parameters. These parameters dictate key aspects of the strategy, such as the look-back periods for indicators, thresholds for entry/exit signals, or even position sizing rules. Consider a simple moving average, MA, crossover strategy. This strategy typically involves two moving averages, a shorter period MA and a longer period MA. When a shorter MA crosses above the longer MA, it generates a buy signal. When it crosses below, a sell signal. The parameters in this strategy are the window lengths for these two moving averages. For example, a 10-period short MA and a 50-period long MA. Changing these numbers fundamentally alters the strategy's signals and, consequently, its profitability. Beyond moving averages, many other common strategies are parametric. RSI, Relative Strength Index, strategies. Parameters include the RSI period, e.g., 14 periods, and overbought/oversold thresholds, e.g., 70/30ths. Bollinger Band strategies. Parameters involve a look-back period for the moving average, e.g., 20 periods, and a number of standard deviations for the bands, e.g., 2 standard deviations. Momentum strategies. Parameters might include the look-back period for calculating momentum, e.g., 12 months, or the number of top-performing assets to select. Stop-loss and take-profit levels. These are often defined as percentages of the entry price, acting as critical parameters in risk management. The challenge and the focus of strategy optimization lies in identifying the optimal combination of these parameters that yields the best possible performance. Defining the optimization problem. To optimize a parametric trading strategy, we must first clearly define the problem. This involves three key components. 1. The parameters, input variables. These are the adjustable numerical values that define the strategy's behavior. Each parameter exists within a specific range, defining its potential values. 2. The objective function, output metric. This is a single, quantifiable metric that measures the strategy's performance for a given set of parameters. The goal of optimization is to maximize or minimize this metric. 3. Constraints. These are conditions that the parameters must satisfy, often rooted in practical or logical considerations. Let's elaborate on each. 1. Parameters and their search space. For our MA crossover example, the parameters are code snippet and code snippet. These are integers representing the number of periods, e.g., days, hours, minutes, used to calculate the moving averages. The set of all possible values that our parameters can take is called the search space or parameter space. For instance, code snippet might range from 5 to 50 peri ODs, and code snippet from 20 to 200 periods. Download the code on OnePageCode Substack. This dictionary code snippet explicitly sets the boundaries for our two parameters, code snippet and code snippet. These ranges define the region within which our optimization algorithm will search for the best parameter values. In addition to ranges, parameters often have constraints. For the MA crossover strategy, a crucial practical constraint is that the short-term moving average window must always be shorter than the long-term moving average window. If code snippet were equal to or greater than code snippet, the strategy would either generate no meaningful signals or behave in an illogical manner, potentially leading to immediate losses or undefined behavior. This constraint ensures the strategy's logical integrity and practical applicability. Download the code on OnePageCode Substack. The code snippet function demonstrates how such a constraint would be enforced. Optimization algorithms need to be aware of these constraints to avoid exploring invalid or nonsensical parameter combinations, saving computational resources and ensuring meaningful results. 2. The objective function. The objective function quantifies the performance of a trading strategy given a specific set of parameters. It takes the parameters as input and returns a single numerical value that represents how good that parameter set is. Our goal is to find the parameters that maximize or minimize, depending on TH. In metric, this value. Common choices for objective functions in quantitative trading include terminal profitability or total return. This is the final profit or loss accumulated by the strategy over the backtesting period. It's straightforward and easy to understand. Pros, directly measures the accumulated wealth. Cons, does not account for the risk taken to achieve that profit. A strategy with high terminal return but extreme volatility might be undesirable. It can also be heavily influenced by single large trades. Sharpe ratio. This metric measures the risk-adjusted return of an investment. It is calculated as the average return earned in excess of the risk-free rate per unit of volatility, standard deviation of returns. Pros, accounts for risk, promoting strategies that achieve good returns with lower volatility. It's widely used in finance for comparing investment performance. Cons, assumes returns are normally distributed, which market returns often are not, and penalizes both upside and downside volatility equally. It can also be manipulated by increasing the frequency of small positive returns. When to choose which. Terminal profitability is suitable when the primary goal is absolute wealth maximization, and you have other, separate mechanisms for risk management, e.g., fixed position sizing, strict stop losses external to the optimization. It's often used for simpler, directional strategies where the focus is purely on the final P&L. Sharpe ratio is G. Generally preferred for robust strategy optimization as it directly integrates risk into the performance evaluation. It helps identify strategies that provide consistent returns relative to the risk taken, making them more resilient and desirable for long-term capital preservation and growth. For most institutional and professional trading, risk-adjusted metrics like Sharpe ratio, Sortino ratio, or Kalmar ratio are standard. For the purpose of this section, we will primarily focus on optimizing for the Sharpe ratio, as it encourages more balanced and robust strategies. The black box function concept. In the context of trading strategy optimization, the objective function is often referred to as a black box function. This means 1. Known inputs and outputs. We know what inputs, parameters, go into the function and what output, performance metric, comes out. 2. Unknown internal logic/derivatives. We do not have an explicit mathematical formula for the function, nor can we easily calculate its derivatives, gradient. The function's internal workings involve complex, path-dependent calculations, simulating trades, calculating P&L, etc., that make analytical differentiation impossible. This black box nature has significant implications for optimization. Gradient-based methods are unsuitable. Optimization techniques that rely on gradients, e.g., gradient descent, cannot be used directly because we cannot compute the derivative of the objective function with respect to its parameters. Computational expense. Evaluating the objective function, i.e., running a backtest for a given set of parameters, is computationally intensive. It involves historical data, signal generation, trade execution simulation, and performance calculation over potentially long periods. This makes methods that require many evaluations, like exhaustive grid search, impractical for high-dimensional parameter spaces. Noisy and nonconvex. The performance landscape of trading strategies is typically noisy. Small changes in parameters can sometimes lead to disproportionately large or erratic changes in performance due to market randomness, discrete events, e.g., price gaps, or the exact timing of trades. A single parameter change might shift a trade entry by one tick, which could drastically alter the outcome of a volatile period. Non-convex. There isn't a single, smooth hill to climb to reach the optimum. Instead, the landscape is often rugged, with multiple local optima, peaks, and valleys. This means that an optimization algorithm could get stuck at a suboptimal solution if it only explores its immediate vicinity. This non-convexity arises from the complex interactions between strategy rules, market dynamics, and the discrete nature of trading signals. Conceptualizing the black box function, code snippet. Let's visualize the steps involved in evaluating a simple MA crossover strategy's performance, which forms our black box function. Download the code on one-page code. Substack. The code snippet function encapsulates the entire process from parameter input to performance output. It's a black box because, from an optimization algorithm's perspective, it just takes code snippet and returns a code snippet. The complex intermediate steps, code snippet, are hidden. The helper functions are conceptual stubs. In a real-world application, these would be robust, thoroughly tested modules of a backtesting engine. Illustrating black box input-output. To further reinforce the black box concept, consider a hypothetical table of various parameter combinations and their corresponding Sharpe ratios. An optimization algorithm iteratively probes this black box by trying different parameter sets and observing the resulting performance. Code snippet Sharpe ratio, output. 1020.85, 1031.12, 1530.98, 2040.75, 525 1.05, 1235 1.25, optimal region, 1236 1.23, 1135 1.19. This table conceptually shows the surface that the optimization algorithm explores. Each row represents a single evaluation of the black box function. The goal is to find the row or combination not yet in the table that yields the highest Sharpe ratio. Download the code on one-page code Substack. LY passes in parameter values and receives a performance score. The optimizer doesn't need to know how that score was calculated, only that it represents the performance of the strategy for those specific inputs. Framing the optimization problem. With these components defined, the trading strategy optimization problem can be formally framed as code snippet, subject to code snippet parameter bounds, code snippet other constraints, e.g., code snippet, where code snippet is our black box objective function, e.g., code snippet. Code snippet is the vector of parameters, e.g., code snippet. Code snippet and code snippet define the lower and upper bounds of a search space for each parameter. Code snippet represents any additional inequality constraints that the parameters must satisfy. This formulation is common across many optimization problems. However, due to the black box, noisy, and non-convex nature of code snippet in trading, traditional optimization methods like exhaustive grid search become computationally prohibitive. A grid search would involve evaluating code snippet at every single combination of parameters within the defined search space. If code snippet has 46 possible values, 5 to 50, and code snippet has 181 possible values, 20 to 200, a full grid search would require 46 181 is equal to 8,326 backtests. Each backtest could take seconds to minutes, quickly leading to hours or even days of computation. This reinforces the need for more efficient optimization technique. UEs, such as Bayesian optimization, which we will explore in subsequent sections. More on optimization. Core concepts. Optimizing a trading strategy involves finding the best possible set of parameters that yield the desired performance. Before diving into advanced techniques like Bayesian optimization, it's crucial to establish a foundational understanding of what optimization entails, the different types of optima, and the unique challenges presented by financial time series and trading strategies. Defining optimization. Key terms. At its core, an optimization problem seeks to find the best input values for a given function to either maximize or minimize its output. In the context of trading, we typically aim to maximize a performance metric, e.g., Sharpe ratio, total return, or minimize risk, e.g., maximum drawdown. Let's define some key terms. Objective function, or fitness function, this is the function we want to optimize. For trading strategies, it's often the backtesting engine that takes strategy parameters as inputs and outputs a performance metric. It's represented as code snippet, where code snippet represents the input parameters. Parameters, or decision variables, these are the inputs to the objective function, denoted by code snippet. In a trading strategy, these could be the look-back periods for moving averages, thresholds for RSI, or allocation percentages. Search space, or domain, this is the set of all possible values that the parameter's code snippet can take. For example, if a moving average window can be between 10 and 200 ys, that defines part of the search space. Optimizer. This is the algorithm or method used to systematically search the parameter space to find the optimal values. Optimal value. F. This is the best possible output value of the objective function, e.g., the highest Sharpe ratio, that can be achieved within the given search space. Maximizer. X. This is the specific set of parameters code snippet that yields the optimal value code snippet. In other words, code snippet is the input that produces code snippet. Consider a simplified scenario where we want to find the optimal moving average window length, code snippet, to maximize our strategy Sharpe ratio, code snippet. Our optimizer would systematically try different code snippet values, calculate code snippet for each, and aim to converge on code snippet that give the highest code snippet. Local versus global optima, finding the true peak. One of the most critical distinctions in optimization is between local and global optima. Global optimum, or global maxima/minima, this is the absolute best, or worst, value of the objective function across the entire search space. It represents the true peak for maximization, or valley for minimization of the function. Local optimum, or local maxima/minima, this is a point in the search space where the objective function's value is better than or worse than for minimization, all nearby points, but not necessarily better than points further away in the search space. Imagine hiking in a mountainous region. The global maximum would be the highest peak in the entire mountain range. A local maximum would be the top of a smaller hill or a lesser peak that you might reach, where all paths immediately around you lead downwards, but there's a taller peak somewhere else in the range. For maximization problems, at a local or global maximum code snippet, the slope, or gradient, of the function is 0. Using our mountain analogy, if you stand at the very top of a peak, local or global, the ground is flat in all directions. There's no immediate upward slope to climb. This concept is crucial for gradient-based optimization methods, which rely on moving in the direction of the steepest ascent or descent until the slope flattens out. Visually, if we plot a function code snippet against code snippet, a global maximum would be the highest point on the entire curve. A local maximum would be a peak that is not the highest overall. Download the code on one Pagecode Substack. In this simple illustration, you can see two peaks. The lower peak on the left is a local maximum because while it's the highest point in its immediate vicinity, there's a higher peak further to the right. The higher peak on the right is the global maximum, representing the absolute best Sharpe ratio achievable for any parameter value in this range. The goal of any robust optimization algorithm in trading is to find the global optimum, as settling for a local optimum means leaving potent tile profits or risk reduction on the table. Challenges of optimizing trading strategies. Optimizing trading strategies presents several significant challenges that make it a non-trivial problem, often requiring sophisticated optimization techniques. The black box nature of strategy performance. A trading strategy's performance, our objective function code snippet, is typically a black box function. This means, 1. No explicit mathematical form. We don't have a simple, closed-form mathematical equation for code snippet. Instead, code snippet is determined by running a complex backtesting simulation. You input parameters code snippet into the backtesting engine, and it outputs a scalar performance metric like Sharpe ratio, profit, or drawdown. 2. No derivative information. Because we don't have an explicit mathematical form, we cannot easily calculate the derivatives, gradients, of the function. This is a major hurdle, as many traditional optimization algorithms, like gradient descent, rely heavily on gradient information to determine the direction of steepest ascent or descent. Without gradients, these methods are not directly applicable. Download the code on one Pagecode Substack. The expense of evaluation. Running a full backtest for a trading strategy can be computationally intensive and time-consuming. It involves loading large historical datasets, simulating every trade over potentially years or decades of data, calculating various performance metrics. If an optimizer needs to evaluate the objective function thousands or even millions of times, as some simple search methods might, the total optimization process can become prohibitively slow. This high cost of evaluation necessitates optimization algorithms that can find good solutions with a minimal number of function calls. The curse of dimensionality. As the number of parameters, code snippet, in a trading strategy increases, the size of the search space grows exponentially. This phenomenon is known as the curse of dimensionality. Consider a strategy with just one parameter code snippet that can take 10 discrete values. An exhaustive search would require 10 evaluations. Now, add a second parameter code snippet that also takes 10 values. The total combinations become code snippet evaluations. Add a third parameter code snippet, 10 values, and it's code snippet evaluations. With code snippet parameters, each having code snippet possible values, the total number of combinations is code snippet. For a typical trading strategy with 5 to 10 parameters, each with a range of possible values, the search space quickly becomes astronomically large, making exhaustive search or grid search computationally infeasible. For example, 10 parameters each with 10 values results in 10 billion combinations. This means that an optimizer cannot simply try everything. The challenge of discrete parameters. Many trading strategy parameters are inherently discrete, meaning they can only take integer values or belong to a finite set of categories. Examples include moving average window lengths. You can have a 20-day MA or a 21-day MA, but not a 20.5-day MA. RSI periods, typically integers like 14. Entry/exit thresholds, often specific price levels or percentages. Indicator types, using MECD versus stochastic oscillator. Standard optimization techniques, particularly those based on gradients, gradient descent, Newton's method, often assume that the objective function is continuous and differentiable over a continuous domain. When parameters are discrete, the concept of a gradient or slope between infinitely close points breaks down. This discontinuity makes it challenging to navigate the search space using gradient-based information. Specialized algorithms are needed to handle discrete or mixed, continuous and discrete, parameter spaces effectively. Noisy objective functions. The performance of a trading strategy can be highly sensitive to the specific historical data used for backtesting. Small changes in market conditions, or even tiny data errors, can lead to noticeable fluctuations in the calculated performance metric. This makes the objective function noisy or stochastic. An optimizer might observe slightly different performance values for the exact same parameters if evaluated multiple times or on slightly different data subsets. This noise can mislead an optimizer, making it harder to identify the true optimal parameters and distinguish real improvements. Random fluctuations. Gradient-based versus gradient-free optimization. Given the challenges outlined above, it's important to understand the fundamental difference between two broad categories of optimization algorithms. Gradient-based optimization. These methods rely on calculating or approximating the gradient, first derivative, of the objective function to determine the direction of steepest descent for maximization or descent for minimization. They iteratively move in this direction until the gradient approaches zero, indicating a local optimum. Examples include gradient descent, stochastic gradient descent, SGD, and Newton's method. Applicability to trading. Generally unsuitable for black box trading strategy optimization because, as discussed, we usually cannot compute the exact gradient of a backtesting performance function. Gradient-free optimization or derivative-free optimization, these methods do not require gradient information. Instead, they explore the search space by sampling different parameter combinations and using only the observed function values, performance metrics, to guide their search. They are designed for situations where the objective function is a black box, noisy, or has discrete parameters. Applicability to trading. Highly suitable for trading strategy optimization. Bayesian optimization falls into this category, as do other metaheuristics like genetic algorithms, simulated annealing, and evolutionary strategies. Escaping local opt. IMA. Strategies for global search. Since gradient-based methods are often trapped in the first local optimum they encounter, gradient-free methods employ various strategies to try and escape local optima and find the global optimum. These techniques typically involve a balance between exploration, searching new, unvisited areas of the search space, and exploitation, focusing the search in promising areas already identified. Here's a brief overview of some conceptual approaches mentioned. Multi-start procedure. This simple strategy involves running the optimization algorithm multiple times, each time starting from a different, randomly chosen initial point in the search space. The best solution found across all runs is then taken as the overall optimum. While straightforward, it can be computationally expensive if many runs are needed and doesn't guarantee finding the global optimum. Random jumps. Some algorithms incorporate elements of random exploration. Periodically, instead of making a small, guided step, the optimizer might make a large, random jump to an entirely new region of the search space. This helps it avoid getting stuck in local optima by providing a chance to escape to a different mountain altogether. Simulated annealing. SA, inspired by the annealing process in metallurgy, heating and slowly cooling a material to reduce defects. SA allows the optimizer to accept worse solutions with a certain probability. This probability is high at the beginning high. GH temperature, allowing for more exploration and jumps out of local optima, and gradually decreases over time, lower temperature, encouraging exploitation of promising regions. Genetic algorithms, GAs inspired by natural selection. GAs maintain a population of candidate solutions, sets of parameters. They then apply operations analogous to biological evolution, such as crossover, combining parts of good solutions, and mutation, randomly altering parts of solutions, to generate new solutions. Solutions that perform better, have higher fitness, are more likely to survive and reproduce, leading to an evolving population that converges towards optimal solutions over generations. These methods, and more advanced ones like Bayesian optimization, are designed to intelligently navigate the complex, high-dimensional, noisy, and potentially discrete search spaces characteristic of trading strategy optimization, with the ultimate goal of locating the elusive global optimum. Global optimization, navigating complex search spaces. Optimizing trading strategies often presents a formidable challenge that transcends simple mathematical solutions. Unlike well-behaved functions found in calculus textbooks, the performance landscape of a trading strategy is typically complex, irregular, and opaque. This section delves into the intricacies of global optimization, specifically addressing the characteristics that make it difficult and the core principles required to tackle it effectively. The problem of global versus local optima revisited. Recall that optimization aims to find the best possible set of parameters, code snippet, that maximizes or minimizes an objective function code snippet. In many real-world scenarios, including trading strategy optimization, the objective function code snippet can have multiple peaks or valleys. A local optimum is a point where the function's value is better than all its immediate neighbors, but not necessarily the best globally. Think of it as being on the top of a small hill in a mountain range. A global optimum is the single best point across the entire search space, the highest peak in the entire mountain range. Traditional optimization methods, particularly gradient-based methods like gradient descent, are highly effective at finding local optima. They work by iteratively moving in the direction of the steepest ascent or descent of the function. However, if the function is nonconvex, meaning its graph C, and have multiple curves and dips, gradient-based methods can easily get stuck in a local optimum, never reaching the true global optimum. For instance, consider a simplified profit function for a trading strategy. Download the code on one patch code Substack. This code snippet is illustrative of a nonconvex surface, where a small change in code snippet or code snippet might lead to a temporary increase in profit, but a much larger, globally optimal profit might exist elsewhere. Gradient-based methods would only explore the immediate vicinity of their starting point. The characteristics of trading strategy optimization problems. Optimizing trading strategies presents unique challenges that make it a prime candidate for global optimization techniques, especially those designed for black box and derivative-free functions. 1. Black box functions. A function is considered a black box if its internal workings are unknown or too complex to express analytically. For trading strategies, the objective function, e.g., annualized return, Sharpe ratio, max drawdown, is typically evaluated through a backtest. You input a set of parameters, and the backtesting engine simulates trades over historical data, then outputs a performance metric. You don't have an explicit mathematical formula code snippet that you can differentiate. Consider how we would define such a function conceptually. Download the code on one patch code Substack. The key takeaway here is that we can query this function with h inputs and get an output, but we cannot inspect or derive its mathematical form. This directly leads to the next challenge. 2. Derivative-free optimization. Since we cannot mathematically express code snippet or its derivatives, we cannot use gradient-based methods that rely on calculating the slope, gradient, of the function to find the direction of improvement. This necessitates derivative-free optimization techniques, which explore the search space by sampling points and observing their objective values, rather than following gradients. 3. Noisy evaluations. Market data is inherently noisy, and backtesting results can be sensitive to small fluctuations or even the specific historical period chosen. This means that evaluating the exact same set of parameters might yield slightly different performance metrics if, for example, the backtest environment had tiny variations or if the strategy has stochastic elements. This noise makes it harder to discern the true underlying performance landscape and can mislead simple search algorithms. 4. Expensive evaluations. Running a backtest can be computationally intensive, especially for complex strategies, long historical periods, or high-frequency data. Each evaluation of code snippet consumes significant time and computational resources. This expense means we cannot afford to evaluate code snippet millions of times, unlike simple analytical functions. We need an optimization method that is sample efficient, meaning it can find a good solution with a limited number of evaluations. Formalizing the optimization problem. To formalize the global optimization problem, we typically define it as follows. We want to find the set of parameters code snippet that maximizes an objective function code snippet over a defined domain code snippet. $\mat f x is gelijk aan \arv max \mat f x in \metcal x ave \mat f x $. Let's break down this notation. Code snippet. This is our objective function, mapping a set of parameters to a real value performance metric. In our context, code snippet would be code snippet. Code snippet. This represents a vector or set of parameters for the trading strategy, e.g., code snippet. Each code snippet is a specific configuration of the strategy. Code snippet. This is the search space or domain of the parameters. It defines the allowable range and types for each parameter. Code snippet. We are seeking to maximize the value of code snippet. If we wanted to minimize, e.g., minimize drawdown, we could maximize the negative of the function. Code snippet. This is crucial. We're not just interested in the maximum value of code snippet, but the specific set of parameters code snippet that produces that maximum value. Code snippet. This denotes the optimal set of parameters we are trying to discover. Understanding the domain code snippet. Bounded, compact, and convex. The professor mentioned the domain code snippet often being bounded, compact, and convex. Let's intuitively understand what these properties mean and why they are important for optimization. Bounded. This means that the search space code snippet has finite limits. For each parameter, there's a minimum and maximum allowable value. For example, a moving average period might be bounded between 10 and 200. Download the code on one patch code substack. Without bounds, the search space would be infinite, making it impossible to systematically explore. Compact. In the context of real numbers, which our parameters usually are, a set is compact if it is both closed and bounded. Closed means that the boundaries themselves are included in the set. For example, the range code snippet is closed because 10 and 200 are valid values, whereas code snippet is not closed. Importance. This ensures that our search space is well-defined and that an optimum can exist within or on its boundary. It prevents the optimizer from falling off the edge into an undefined region. Convex. A set is convex if, for any 2 points within the set, the straight line segment connecting those 2 points lies entirely within the set. For a multidimensional parameter space, this means there are no holes or indentations in the search region. Importance. While not strictly necessary for all global optimization techniques, a convex domain simplifies the search problem. It ensures that if we are searching within a defined region, we won't accidentally step outside of it by taking a direct path between two valid points. For many practical applications, we can define our parameter ranges to be convex, e.g., simple hyperrectangles. Here's how you might define a search space in Python using a common library for optimization, like CodeSnippet or CodeSnippet, which implicitly handles these properties. Download the code on one patch code substack. This code snippet list clearly defines the code snippet for our code snippet problem, with each parameter having its specific bounds and type. The critical exploration-exploitation trade-off. Given that we are dealing with black box, derivative-free, noisy, and expensive objective functions, a naive exhaustive search is impossible. We need an intelligent search policy that balances two fundamental, often conflicting, objectives. 1. Exploration. Trying out new, previously unvisited regions of the parameter space. This is crucial for discovering potentially better global optima that might be far from already tested points. 2. Exploitation. Focusing the search on regions that have already shown promising results. This aims to refine existing good solutions and find local improvements. The direct link between derivative-free optimization and the need for an intelligent search policy that balances exploration and exploitation is profound. Because we lack gradient information, we cannot simply follow a slope to the optimum. Instead, we must strategically sample the function. An intelligent policy decides where to sample next based on past observations. Too much exploration might waste evaluations on unpromising areas. Too much exploitation might get stuck in a local optimum. The goal is to efficiently navigate the unknown landscape. Real-world analogy. Trading strategy parameter tuning. Imagine you're tuning a trading strategy with two main parameters. Code snippet, e.g., look-back period for an indicator, and code snippet, e.g., a buy-sell threshold. Exploration. You might start by trying vastly different combinations. Code snippet, then code snippet. You're casting a wide net to see which general areas of the parameter space yield any kind of positive performance. This is like scouting different mountain ranges to see which one has the highest peaks. Exploitation. Suppose code snippet gives a promising result. You would then focus your next evaluations around this point. Code snippet, trying to fine-tune and climb the local peak. This is like finding a promising hill and meticulously searching its slopes for the very highest point. An effective global optimizer will dynamically switch between these modes, exploring new territory when uncertainty is high or a promising new region is identified, and exploiting known good regions to refine the optimal parameters. Beyond gradient descent, other global optimization approaches. While gradient-based methods are excellent for convex problems, they are insufficient for the black box, non-convex nature of trading strategy optimization. Other techniques have been developed to tackle global optimization problems, each with its own strengths and weaknesses. Genetic algorithms, GAs inspired by natural selection. GAs maintain a population of candidate solutions. They evolve this population over generations through processes like selection, crossover, combining solutions, and mutation, random changes, to find better solutions. They're good at exploring vast, complex spaces. Simulated annealing. SA, inspired by the annealing process in metallurgy. SA explores the search space by accepting new solutions that are sometimes worse than the current one, especially early in the search. This allows it to escape local optima. The temperature parameter gradually decreases, making it less likely to accept worse solutions over time, eventually converging. Random search simply samples points randomly from the search space. While often surprisingly effective in high-dimensional spaces, it is not intelligent and can be inefficient. These methods, along with Bayesian optimization, which we will explore in detail in subsequent sections, are designed to tackle the global optimization challenge by employing intelligent search strategies that effectively balance exploration and exploitation, without relying on gradient information. Broader applications of global optimization. The challenges and solutions discussed for trading strategy optimization are not unique to finance. Global optimization for black box, derivative-free, noisy, and expensive functions is critical in many other fields. Machine learning. Hyperparameter tuning of complex models, e.g., neural networks, gradient boosting machines, is a classic example. The model's performance, e.g., accuracy, F1 score, is the black box objective function, and evaluating it requires training the model, which is expensive. Experimental design. Optimizing chemical processes, drug discovery, or material science often involves expensive, real-world experiments where the relationship between inputs and outputs is unknown. Engineering design. Fine-tuning parameters for complex simulations, e.g., aerospace, automotive design, where each simulation run is computationally costly. Understanding the principles of global optimization, particularly the exploration-exploitation trade-off, provide the powerful framework for tackling these complex problems across various domains. Defining the objective function. In the realm of quantitative trading and machine learning, An objective function, also known as a fitness function or cost function, serves as the ultimate arbiter of success. It is a mathematical mapping that takes a set of input parameters or hyperparameters and returns a single, scalar value representing the goodness or badness of those inputs. The goal of optimization is then to find a set of inputs that either maximizes, e.g., Sharpe ratio, trading profit, model accuracy, or minimizes, e.g., validation loss, drawdown, this output value. For trading strategy, the inputs might be parameters like look-back periods for indicators, stop-loss percentages, or position sizing rules. The output would be a performance metric derived from a backtest. For a machine learning model, the inputs are hyperparameters like learning rate, number of layers, or regularization strength, and the output is typically a performance metric on a validation dataset, such as accuracy or mean squared error. Characteristics of objective functions in quantitative trading and machine learning. Optimizing these objective functions presents unique challenges due to several inherent characteristics that distinguish them from the well-behaved functions often encountered in classical optimization problems. 1. Black box nature. A function is considered black box when its internal workings are opaque, meaning we can only observe its outputs for given inputs without Kn, owing its analytical form or derivative. In our context, this means we can't write down a simple equation for code snippet or code snippet. Instead, evaluating these functions involves executing complex, often time-consuming simulations or training processes. Consider a conceptual Python function for evaluating a trading strategy. Download the code on one Pagecode Substack. This first chunk illustrates the signature of a black box function for a trading strategy. The function takes several parameters as input and returns a single performance metric, Sharpe ratio. The key takeaway is that the internal implementation, which involves loading historical data, simulating trades, and calculating complex financial metrics, is not analytically exposed. We just provide inputs and get an output. Similarly, for machine learning models, evaluating hyperparameter combinations involves training and validating the model. Download the code on one Pagecode Substack. This second chunk shows a similar black box structure for an ML model evaluation. The function encapsulates the entire training and validation pipeline, which is a complex series of operations: data loading, model definition, training loops, inference on validation sets. Again, we don't have an explicit mathematical formula for code snippet. This black box nature means we cannot use analytical methods that rely on knowing the function's explicit form or its derivatives. 2. Noisy evaluations. The evaluation of objective funct. Ions in these domains is often subject to significant noise. This means that if we evaluate the exact same set of parameters multiple times, we might get slightly different results. For trading strategy backtests, sources of noise include market randomness, even with historical data, the specific sequence of trades, micro slippage, and order book dynamics are subject to inherent randomness that can affect final profitability metrics. Different backtesting engines or slight variations in data feeds can yield different results. Specific historical periods. A strategy performing well in a bull market might fail in a bear market or during periods of high volatility. The choice of the backtesting period can significantly influence the observed performance, making it a form of noise if the goal is truly robust performance across all regimes. Data quality issues, missing data, errors in historical quotes, or survivorship bias, only including currently existing assets, can introduce inaccuracies that manifest as noise in performance metrics. Transaction costs and liquidity. Realistic modeling of these factors is complex and can introduce variability. For machine learning model training, sources of noise include random initialization. Neural network weights are typically initialized randomly, leading to different training trajectories and slightly different final models even with the same hyperparameters. Mini-batch sampling, stochastic gradient descent, SGD, and its variant. Use mini batches of data, introducing randomness into each gradient update step. Dropout, a regularization technique that randomly drops units during training, adding stochasticity. Validation set variability. The specific split of data into training and validation sets can impact the reported validation loss. This inherent noise complicates optimization because a seemingly better result might just be a lucky noisy observation rather than a genuinely improved parameter setting. Bayesian optimization is particularly well suited for noisy objective functions because it explicitly models the uncertainty in its predictions, allowing it to distinguish between true improvements and mere noise. 3. Costly evaluations. Evaluating a single set of parameters for a trading strategy or an ML model is computationally expensive. Trading strategy backtests. A comprehensive backtest often involves simulating trades over many years of historical data, e.g., 10 to 20 years of tick data. This requires loading large data sets, performing calculations for each price update or bar, managing orders, and computing a wide array of performance metrics. A single backtest can take anywhere from a few minutes for a simple strategy on daily data to several hours or even days for complex high-frequency strategies on tick data across many assets. Machine learning model training. Training deep neural networks or complex models on large data sets can consume significant computational resources, CPUs, GPUs, and time. A single training run for a state-of-the-art model might take hours or days, even on powerful hardware. The high cost of each evaluation severely limits the number of parameter combinations we can test. Traditional methods like exhaustive grid search, which evaluate every point in a predefined grid, quickly become intractable as the number of parameters or their ranges increase. For instance, if each evaluation takes 1 hour and we have 5 parameters, each with 10 possible values, a grid search would require $10^5 evaluations, totaling over 11 years of computation, $100,000 tax hours approximate 11.4 tax years dollar. This computational burden necessitates optimization techniques that are sample efficient, meaning they can find good solutions with a minimal number of evaluations. 4. Lack of gradient information. Many traditional optimization algorithms, such as gradient descent, rely on calculating the gradient, the direction of steepest ascent or descent of the objective function. However, for trading strategies and ML hyperparameters, gradient information is typically unavailable or unreliable. Non-differentiable operations. Trading strategies often involve discrete decisions, code snippet. These code snippet conditions, discrete order executions, and integer-valued parameters, like moving average periods or RSI lookback periods, introduce discontinuities and make the objective function non-differentiable. A tiny change in a parameter might add to a sudden, large jump in performance or no change at all, rather than a smooth, continuous curve. Discrete parameters. Many parameters are inherently discrete, e.g., number of hidden layers in a neural network, choice of activation function, or an integer lookback period. For discrete parameters, the concept of a gradient, which requires infinitesimal changes, is ill-defined. Let's illustrate the issue with discrete parameters. Consider a parameter code snippet that can only take integer values. Download the code on one patchcode Substack. This function code snippet behaves differently depending on the integer value of code snippet. There's no smooth transition that allows for calculating a gradient using calculus. For example, the gradient between code snippet and code snippet is undefined because the function jumped from code snippet to code snippet at code snippet, and from code snippet to code snippet it jumps from code snippet to code snippet. Download the code on one patchcode Substack. Download the code on one patchcode Substack. As seen from the output, a change from code snippet to code snippet results in a dramatic, discontinuous jump in the objective value. This makes it impossible to compute a meaningful gradient. Gradient-based optimizers simply cannot operate in such a landscape. Consequently, we must rely on derivative-free optimization methods. 5. Non-convexity and multiple optima. Finally, the objective functions for trading strategies and ML hyper. Parameters are almost universally non-convex. A convex function has a single, global minimum or maximum, and no other local optima. Nonconvex functions, however, can have multiple local optima, where the function value is better than its immediate neighbors, but not the global best. Trading strategies. The performance landscape of a trading strategy is highly complex due to regime changes. Market dynamics shift over time, e.g., trending versus mean reverting, low versus high volatility. A strategy optimized for one regime might perform poorly in another, leading to different peaks in the objective function corresponding to different market conditions. Nonlinear interactions. Parameters interact in complex, nonlinear ways. Changing one parameter might have a cascading effect on others, creating a rugged and undulating performance surface. Transaction costs and slippage. These factors introduce nonlinear penalties that can create sharp drops or flat regions in the objective function. Machine learning models. The loss landscapes of deep neural networks are notoriously nonconvex, characterized by numerous local minima, saddle points, and wide flat regions. The presence of multiple local optima means that local optimization algorithms, which only search for improvements in the immediate vicinity of the current point, are prone to getting stuck at a suboptimal solution. To find the truly best set of parameters, we need global optimization techniques that are designed to explore the entire search space effectively and avoid being trapped in local optima. In summary, the objective functions encountered in quantitative trading and machine learning hyperparameter tuning are characterized by being black box, noisy, costly to evaluate, gradient-free, and nonconvex. These combined attributes render traditional optimization methods inefficient or entirely inapplicable, thereby establishing a strong rationale for the adoption of more sophisticated and sample-efficient global optimization techniques, such as Bayesian optimization. Bayesian optimization. Optimizing complex systems, especially those encountered in quantitative finance and machine learning, often involves dealing with code snippet functions. These are functions whose internal workings are unknown or too complex to model explicitly. Furthermore, evaluations of these functions can be code snippet, time-consuming, resource-intensive, and code snippet. Results vary due to stochasticity. Traditional optimization methods, which often rely on gradient information or many evaluations, are ill-suited for such scenarios. This is where Bayesian optimization, BO, shines. Bayesian optimization is a sequential, model-based optimization strategy designed to find the global optimum of an objective function that is expensive to evaluate, noisy, and lacks an explicit mathematical form or gradient information. Instead of directly optimizing the objective function, BO builds a probabilistic surrogate model of the function and then uses this model to intelligently decide where to sample next. The probabilistic surrogate model, Gaussian processes. At the heart of Bayesian optimization lies a code snippet. This model serves as a cheap-to-evaluate approximation of our true, expensive objective function. Crucially, it not only predicts the function's value, but also quantifies the uncertainty in that prediction. This uncertainty is vital for guiding the optimization process. The most common choice for the probabilistic surrogate model is a code snippet. A Gaussian process can be thought of as a distribution over functions. Unlike a Gaussian distribution, which describes a distribution over random variables, a GP describes a distribution over functions. This means that for any set of input points, the corresponding function values are jointly Gaussian distributed. Why are Gaussian processes particularly suitable for Bayesian optimization? 1. Non-parametric. GPs are flexible and can model complex, nonlinear relationships without assuming a specific functional form. 2. Uncertainty quantification. A GP provides not just a mean prediction for any given input, but also a variance or confidence interval around that prediction. This variance directly represents the model's uncertainty. Regions with high uncertainty are where the model has little data, making them potentially interesting for code snippet. 3. Bayesian updating. As new data points, input-output pairs from the objective function, are acquired, the GP model can be efficiently updated using Bayesian inference. This allows the surrogate model to become more accurate and reduce its uncertainty in sampled regions. Let's begin by defining a synthetic objective function to illustrate the concepts. For simplicity, we'll use a 1D function, which is easy to visualize. Download the code on OnePageCode Substack. This code defines code snippet, our black box function we want to optimize. It's designed to have a non-trivial shape and includes noise, simulating real-world scenarios. Code snippet array defines the parameter space we will explore. Next, we need to set up our Gaussian process regressor. The code snippet defines the covariance function, which specifies the smoothness and general shape of the functions we expect the GP to model. The code snippet kernel is a popular choice due to its flexibility. Download the code on OnePageCode Substack. Here, we instantiate code snippet from code snippet. Code snippet is a parameter that adds a small amount of noise to the diagonal of the covariance matrix, which can help with numerical stability and represent inherent noise in the objective function. Code snippet normalizes the target values, which can improve the GP's performance. The acquisition function, guiding exploration and exploitation. The second core component of Bayesian optimization is the code snippet. While the surrogate model provides predictions and uncertainties, the acquisition function uses this information to determine the most promising next point to evaluate. Its primary role is to balance the fundamental code snippet. Exploitation, sampling points where the surrogate model predicts high objective values, i.e., exploiting current knowledge of good regions. Exploration, sampling points where the surrogate model has high uncertainty, even if the predicted mean is not the highest, i.e., exploring unknown regions that might contain better optima. Without a proper balance, the optimization might get stuck in local optima too mu. Exploitation, or waste evaluations in unpromising regions, too much exploration. Common acquisition functions include expected improvement. This function estimates how much improvement over the current best observed value can be expected by sampling a new point. It favors points with high predicted values and high uncertainty. Upper confidence bound. This function selects points that maximize a weighted sum of the predicted mean and the predicted uncertainty. The weighting parameter, code snippet or code snippet, controls the balance between exploitation, mean, and exploration uncertainty. A higher weight on uncertainty encourages more exploration. Let's implement a simple acquisition function for our 1D example. Download the code on OnePageCode Substack. The code snippet function takes a set of points code snippet and the current code snippet. It predicts the mean and standard deviation at these points and combines them using the code snippet parameter. The goal is to find the code snippet that maximizes this code snippet value. The iterative Bayesian optimization loop. Bayesian optimization proceeds in an iterative loop. 1. Initialization. Start with a few initial data points by evaluating the objective function at randomly chosen locations. These points are used to train the initial surrogate model. 2. Model fitting. Train or update the probabilistic surrogate model, e.g., GP, using all observed data points. 3. Acquisition function optimization. Use the current surrogate model to optimize the acquisition function over the search space. The point that maximizes the acquisition function is the next candidate point to evaluate. This step is usually much cheaper than evaluating the true objective function. 4. Objective evaluation. Evaluate the true, expensive objective function at the new candidate point. 5. Data update. Add the new input-output pair to the set of observed data. 6. Repeat. Go back to step 2 until a stopping criterion is met, e.g., maximum number of evaluations, convergence. This iterative process ensures that each new evaluation is strategically chosen, leveraging both the current knowledge of the objective function and the uncertainty about unexplored regions. Let's put together the core iteration loop. We'll need a way to find the maximum of the acquisition function. For 1D, a simple grid search is feasible But for higher dimensions, more sophisticated optimization algorithms, like code snippet or code snippet from code snippet, are used to optimize the acquisition function. Download the code on one pagecode Substack. We start by evaluating our synthetic objective function at a few random points. These points form our initial dataset code snippet and code snippet, which will be used to train our first GP model. Download the code on one pagecode Substack. In this part, we fit the GP model with our initial data. Then, we enter the main loop. Inside the loop, we define a code snippet function because. So code snippet, find minimum. We use code snippet with the code snippet method in our define code snippet to find the code snippet that maximizes the acquisition function. Download the code on one pagecode Substack. Here, we evaluate the expensive code snippet at the code snippet chosen by the acquisition function. This new data point, code snippet, is then added to our code snippet and code snippet datasets. Finally, the GP model is retrained with the expanded dataset, allowing it to refine its understanding of the objective function and its uncertainties for the next iteration. This concludes a single iteration of the BO loop. Practical considerations and applications. While powerful, Bayesian optimization is not without its considerations. Computational cost of Gaussian processes. The computational cost of fitting a GP scales cubically with a number of data points, code snippet. This means that for very large data sets, thousands or tens of thousands of evaluations, GP-based BO can become slow. Alternative surrogate models, such as random forests or neural networks, are sometimes used in these scenarios, though they typically don't provide the same level of uncertainty quantification as GPs. Dimensionality. Bayesian optimization performs best in low to medium dimensional spaces, typically up to 20 to 30 parameters. As the number of dimensions increases, the search space grows exponentially, making it harder for the GP to accurately model the function, and for the acquisition function to efficiently guide exploration. Choice of kernel and acquisition function. The performance of BO can be sensitive to the choice of GP kernel and acquisition function. Experimentation and understanding their properties are crucial. Applications in quantitative finance and machine learning. Trading strategy parameter tuning. This is a prime application. Imagine a trading strategy with parameters like moving average window lengths, Bollinger Band deviations, or look-back periods for an RSI indicator. Evaluating the strategy's performance, e.g., Sharpe ratio, maximum drawdown, profit factor, by backtesting with different parameter sets can be computationally very expensive. Bayesian optimization can efficiently navigate this high-dimensional, noisy, and expensive search space to find optimal or near-optimal parameters. Machine learning hyperparameter tuning. Hyperparameters, e.g., learning rate, batch size, number of layers, regularization strength, of complex models like deep neural networks or gradient boosting machines significantly impact performance. Training and evaluating these models for each hyperparameter combination is costly. BO provides a principled way to explore the hyperparameter space effectively, often outperforming grid search or random search. A/B testing optimization. In scenarios where evaluating the impact of different website features or marketing campaigns involves costly experiments, BO can help intelligently choose the next set of variations to test. By systematically building a probabilistic understanding of the black box objective and strategically selecting points for evaluation, Bayesian optimization offers a robust and efficient framework for tackling challenging optimization problems across various domains. Gaussian processes. Gaussian processes, GPs, serve as the cornerstone of Bayesian optimization, providing a flexible and powerful way to model complex, unknown objective functions. Unlike traditional regression models that output a single prediction, a Gaussian process models a distribution over functions. This probabilistic approach is critical because it quantifies the uncertainty in its predictions, which is exactly what Bayesian optimization leverages to balance exploration, sampling uncertain regions, and exploitation, sampling promising regions. What is a Gaussian process? Conceptually, A Gaussian process extends the idea of a Gaussian, normal, distribution from random variables to random functions. Just as a Gaussian distribution is fully defined by its mean and variance, or covariance for multiple variables, a Gaussian process is fully defined by a mean function and a covariance function, also known as a kernel. Imagine you have a set of input points, $x equals backslash, x1, x2, backslash dots, xn backslash dollar. If you were to evaluate an unknown function $f, x, dollar at these points, you would get a set of outputs $f, x equals backslash if x1, f x2, backslash dots, f xn, backslash dollar. A Gaussian process states that any finite collection of these function values $f, x, dollar follows a multivariate Gaussian distribution. This means $f fix, simat celevasložná závorka n pravasložná závorka mu fix, fix, $. Here, $mu x. Dollar is a vector where each element $mu 11. Dollar is the output of the mean function at $11, and $k, x, x. Dollar is a covariance matrix where each element $k. 11, xj. Dollar represents the covariance between the function values at $11 and $xj, as defined by the covariance function. This concept of an infinite number of normally distributed random variables translates practically into modeling the relationship between any 2 points in the input space. The GP doesn't just predict a value. It predicts a range of probable values, along with the confidence in that range. The mean and covariance functions. Every Gaussian process is specified by its mean function and its covariance, kernel, function. The mean function. The mean function $mu x, dollar, describes the expected value of the function at any given input $x. For many applications, especially when we have no prior knowledge about the function's general shape, it's common to set the mean function to 0. $mu x equals $0. This assumes that, in the absence of any observations, the most likely value for the function at any point is 0. If there's some known baseline or prior belief about the function's average behavior, a non-zero mean function can be used. The covariance, kernel, function. The covariance function $k, 11, xj$, is the heart of a Gaussian process. It defines the similarity or relationship between any 2 input points $11 and $xj$. A larger covariance value between 2 points implies that their corresponding function values are more likely to be similar. Conversely, a smaller covariance implies they can vary more independently. This function determines the smoothness, periodicity, and general shape properties that the GP expects from the unknown function. The covariance function implicitly defines the structure of the objective function we are trying to model. Choosing an appropriate kernel is crucial because it encodes our assumptions about the underlying function. Let's look at some common kernel types. Radial basis function, RBF, kernel, also known as squared exponential kernel. This is perhaps the most widely used kernel. It assumes that points closer in the input space are more correlated. It produces very smooth functions. $k, 11, xj equals backslash sigma caret 2 backslash exp backslash left dash backslash frac backslash 11 xj backslash caret 2 L squared backslash right $. Here, backslash sigma caret $2 output variance controls the overall magnitude of the function values. $L length scale determines how quickly the correlation between points decays with distance. A small code snippet implies that points only very close to each other are correlated, leading to rapidly varying functions. A large code snippet implies a slow decay, leading to smoother functions. Mattern kernel. This kernel is a generalization of the RBF kernel and offers more flexibility in controlling the smoothness of the function. It has a parameter $new$ that controls the differentiability. Common variants are mattern 3/2 and mattern 5/2. K, xi, xj, sigma 2 frag 2 lima, nu, lift, frag 5 xfeg, nuke nu lift, where $k\new$ is a modified Bessel function of the second kind. The Mattern 3 halves kernel, for instance, implies functions that are once differentiable, while Matter 5 halves implies functions that are twice differentiable. This is often more robust than RBF, as it can model functions that are not infinitely differentiable. White noise kernel. This kernel adds a constant value to the diagonal of the covariance matrix, effectively modeling observation noise. It's crucial for handling real-world noisy data. The parameters of these kernels, like code snippet and $sigma_2, are called hyperparameters of the Gaussian process itself. These are typically optimized by maximizing the marginal likelihood of the observed data, which is a key part of fitting a GP. Intuition. How kernels define similarity. Consider the RBF kernel. If 2 points, $11 and $xj are identical, $11, xj\2 equals $0, and the kernel value is $sigma_2. As the distance $11, xj\$ increases, the exponential term $exp-text distance $2/2L², rapidly approaches 0. This means that points far apart have very little covariance, indicating their function values are largely independent. The length scale code snippet dictates how fast this decay happens. A smaller code snippet means the function is expected to change quickly, while a larger code snippet means it's expected to change slowly, thus being smoother. Constructing the GP model, prior and posterior. The power of Gaussian processes in Bayesian optimization comes from their ability to update their belief about the unknown function as new observations become available. This process moves from a prior belief, before any data, to a posterior belief, after observing data. The GP prior. Before we observe any data points from our objective function, e.g., before running any backtests for a trading strategy, the GP represents our initial belief about the function. This initial belief is solely determined by the chosen mean and covariance functions. We can sample functions from this prior distribution to visualize what kind of functions the GP expects to see. Let's illustrate defining a GP prior and sampling from it using code snippet. Download the code on OnePageCode Substack. In this initial step, we define the code snippet, which encapsulates our assumptions about the function's smoothness and scale. Code snippet sets the initial output variance $sigma_2 to 1.0, and code snippet sets the initial length scale $L to 1.0. The code snippet is then instantiated with this kernel. The code snippet indicates that we are assuming noise-free observations for now, which simplifies the prior. Finally, we use code snippet to draw 5 random functions from this prior distribution. These are functions that the GP considers equally likely before any data is observed. Download the code on OnePageCode Substack. This plot visually demonstrates the distribution over functions. Each line represents a different function that is consistent with our chosen kernel and its hyperparameter. RS. Notice how these functions are generally smooth, reflecting the properties of the RBF kernel. The spread of these lines across the y-axis gives an intuitive sense of the prior uncertainty. The GP posterior. Once we make an observation, e.g., evaluate our trading strategy at a specific parameter setting and get a Sharpe ratio, the GP updates its belief about the unknown function. This updated belief is called the posterior process. The posterior mean function will pass through the observed data points, and the posterior variance will shrink around these points, reflecting increased certainty. As we move away from observed points, the uncertainty variance increases again, illustrating the need for further exploration. The formulas for the posterior mean $mu post x and posterior covariance $k post x are derived from conditional Gaussian distributions. Given observed data $d equals \11 phi \I equals 1 caret and $move post x mu x plus que x Xing o Xing bluesigen venata finto Xing. $K post XX equals K XX K X K plus backslash sigma caret 2 I caret 1 X $. Let's break down these components. $X in $. The matrix or vector of input locations where we have made observations. $F and $. The vector of observed function values corresponding to $X and $. This is the code snippet in our code examples. $mu x $. The prior mean function evaluated at a new test point $x $. $mu x $. The prior mean function evaluated at the obs. Revet input points $x and $. $K x $. A vector of covariances between a new test point $x $, and all observed input points $x and $. This is often denoted as $K $. $K x $. The covariance matrix, gram matrix, of the observed input points $x and $, with themselves. This is often denoted as $K $. $K x $. The prior covariance between two new test points $x $, and $x $. For the variance calculation, $x equals x $. This is often denoted as $K $. Sigma caret 2 $. The noise variance, representing the uncertainty in our observations. If observations are assumed noise-free, $sigma caret 2 equals $0. In code snippet, this is handled by the code snippet parameter or a code snippet. $K x plus sigma caret 2 I caret $1. The inverse of the noisy covariance matrix of the observed data. This is the computationally expensive part, especially for large $. Intuition behind the formulas. Posterior mean. The posterior mean is the prior mean adjusted by a weighted sum of the observed residuals, $f mu $. The weights are determined by the covariance between the test point $x $, and the observed points $x and $, scaled by the inverse of the observed data's covariance matrix. Essentially, it's a linear combination of the observed function values, where points closer to the prediction point $x $, as defined by the kernel, have a greater influence. Posterior variance. The posterior variance is the prior variance $K x $, reduced by a term that account for the information gained from OB. Observations. The amount of variance reduction depends on how correlated the test point $x $, is with the observed points $x and $. If $x $, is close to an observed point, $K x $, will be large, leading to a significant reduction in variance. If $x $, is far from all observed points, $K x $, will be small, and the variance reduction will be minimal. This explains why the G-piece variance increases as one moves further away from observed data points. There's simply less information to constrain the function in those regions. Let's demonstrate fitting a GP to synthetic data and visualizing its posterior. Download the code on OnePageCode Substack. Here, we first define a simple code snippet to simulate our unknown trading strategy performance. We then generate a small set of code snippet and code snippet points, adding a small amount of Gaussian noise to code snippet to make it more realistic. The code snippet now includes a code snippet to explicitly model this observation noise. The code snippet is then code snippet to this observed data, which optimizes the kernel hyperparameters, e.g., code snippet, by maximizing the marginal likelihood. Finally, code snippet provides both the predicted mean function values, code snippet, and the standard deviation, code snippet, at all points in code snippet. Download the code on OnePageCode Substack. This plot is highly illustrative. The blue line represents the G-piece best estimate, posterior mean, of the true function, WH. It passes directly through the red observation points. The shaded blue region is the 95% credible interval, mean $PM 1.96 standard deviations, representing the G-piece uncertainty. Notice how this interval is narrow around the observed data points, where uncertainty is low and widens as we move further away from them, where uncertainty is high. This visual clearly shows how the GP quantifies uncertainty and how observations reduce it locally. Dynamic updates of the GP. The strength of GPs in Bayesian optimization lies in their ability to dynamically update as new observations are acquired. Each new evaluation of the objective function, e.g., a new backtest result, is added to the training data and the GP is refitted. This process refines the posterior mean and shrinks the credible intervals, leading to a more accurate surrogate model. Let's simulate adding more observations and refitting the GP. Download the code on OnePageCode Substack. This comprehensive visualization demonstrates the iterative nature of Bayesian optimization. Each subplot shows the GP's belief after an increasing number of observations. As more points are added, particularly in regions of high uncertainty, the GP's posterior mean more closely approximates the true function, and the credible intervals narrow down significantly. This dynamic refinement is what makes GPs so effective for sequential optimization. Computational considerations and noise handling. Computational complexity. While powerful, Gaussian processes are not without computational limitations. The most significant bottleneck arises from the matrix inversion step in the posterior mean and variance calculations. $k x plus backslash sigma caret 2 I caret dash $1. For $$ observations, this involves inverting in $n backslash times in dollar matrix, which has a computational complexity of $o n cubed dollar. Predicting new points has a complexity of $o n squared dollar. This cubic complexity means that GPs become computationally prohibitive for very large datasets, typically $n greater than $10,000. For hyperparameter optimization and trading, where evaluations are expensive but the number of evaluations is usually limited, e.g., hundreds, not thousands, this is generally not an issue. However, for applications with massive datasets, sparse GP approximations or other surrogate models might be necessary. Handling real-world noise. Our initial discussion assumed noise-free and exact observation model for simplicity. In reality, objective function evaluations, like Sharpe ratios for backtests, are almost always noisy. Factors like market microstructure, data quality, and even the stochastic nature of market simulations can introduce noise. GPs naturally handle observation noise by adding a noise variance term, $sigma caret $2, to the diagonal of the covariance matrix $k, x $. This effectively means that observations are not treated as exact points on the function, but rather as noisy measurements. The code snippet in code snippet explicitly models this now. ISE, and its code snippet becomes another hyperparameter to be optimized. When noise is present, the posterior mean will no longer strictly pass through the observed data points, but will instead represent the most likely underlying true function, smoothing out the noise. The credible intervals will also account for the observation noise, leading to slightly wider intervals even at the observed points, reflecting the inherent uncertainty in the measurements themselves. Practical implications of kernel choice. The choice of kernel function has profound practical implications for modeling a trading strategy's performance. Smoothness assumptions. An RBF kernel assumes an infinitely smooth function. If your trading strategy's performance, e.g., Sharpe ratio, changes abruptly with small parameter adjustments, e.g., discrete changes in look-back periods or thresholds, an RBF kernel might oversmooth the model. A Mattern 3 halves or 5 halves kernel might be more appropriate, as they allow for less smooth but still continuous functions. Periodicity. If you suspect your objective function might have periodic behavior, e.g., performance related to a cyclical market factor, a periodic kernel could be incorporated. Parameter sensitivity. The length scale code snippet in the RBF kernel directly impacts how sensitive the GP believes the function is to changes in input parameters. A small code snippet implies high sensitivity, rapid changes, while a large code snippet implies low sensitivity, slow changes. Understanding the expected behavior of your trading strategy's parameters can guide the initial choice or bounds for code snippet. Combining kernels. Kernels can be combined, e.g., summed or multiplied, to model more complex function behaviors. For instance, code snippet models a smooth function with observation noise. Code snippet models a smooth periodic function. In practice, the kernel hyperparameters are typically optimized during the GP fitting process by maximizing the marginal likelihood, which automatically finds the kernel parameters that best explain the observed data. However, having a good initial understanding of your objective function's expected behavior helps in selecting an appropriate base kernel family. For instance, if you expect very rough or non-differentiable behavior, a standard RBF might be a poor choice. By understanding Gaussian processes as probabilistic models that quantify uncertainty and dynamically update with observations, we lay the groundwork for understanding how Bayesian optimization efficiently navigates the search space for optimal trading strategy parameters. Acquisition function. The power of Bayesian optimization lies in its intelligent strategy for selecting the next point to evaluate. This strategy is embodied by the acquisition function, often denoted as code snippet. While the Gaussian process, GP, provides a probabilistic surrogate model of the objective function, the acquisition function leverages this model to decide where to sample next in the search space. It acts as the policy that guides the optimization process, translating the GP's uncertainty and predictions into a concrete proposal for the next experiment. The exploration-exploitation trade-off. A central challenge in any optimization or learning process is managing the exploration-exploitation trade-off. This dilemma is particularly acute in black box optimization, where function evaluations are expensive. Exploitation. Sampling points in regions where the surrogate model predicts high objective values, i.e., near the current best known optimum. This aims to refine the current best solution. Exploration. Sampling points in regions where the surrogate model has high uncertainty. This aims to discover potentially better, unobserved parts of the search space. Pure exploitation can lead to getting stuck in local optima, while pure exploration can be inefficient, evaluating many points that yield little improvement. The acquisition function's primary role is to strike a judicious balance between these two competing objectives. It quantifies the utility, or desirability, of evaluating a candidate point code snippet, taking into account both the predicted mean and the uncertainty variance from the Gaussian process. Mathematical foundations of acquisition functions. Acquisition functions are functions of the posterior distribution provided by the Gaussian process. For a given candidate point code snippet, the GP provides a predicted mean code snippet and a predicted variance code snippet. Acquisition functions combine these two pieces of information in various ways to prioritize candidate points. Expected improvement, EI. Expected improvement, code snippet, is one of the most widely used and intuitive acquisition functions. It quantifies the expected gain that could be achieved by evaluating a new point code snippet relative to the current best observed value. It focuses on how much improvement we can expect over the best point found so far, code snippet. The intuition behind code snippet is that it favors points that are likely to yield a significant improvement over the current best, considering both their predicted value and the uncertainty. Points with a high predicted mean and high uncertainty, allowing for the possibility of a much higher actual value, will have a high code snippet. The mathematical formulation for expected improvement for a minimization problem, where we want to find the minimum code snippet, is $EIX equals \mu x, fbest, \5 left, \mu x, fbest, sigma x, right, plus sigma x, \5 left, fr. AC \mu x, fbest, sigma x, right. Where? Code snippet. The predicted mean of the objective function at point code snippet from the Gaussian process. Code snippet. The predicted standard deviation of the objective function at point code snippet from the Gaussian process. Code snippet. The best observed value of the objective function so far. Code snippet. The cumulative distribution function, CDF, of the standard normal distribution. Code snippet. the probability density function, PDF, of the standard normal distribution. For maximization problems, the formula is slightly different, often involving code snippet and adjusted signs, or simply optimizing for the negative of the objective function. For clarity, we'll stick to the minimization convention for code snippet. Let's implement code snippet in Python, breaking it down into small, understandable parts. We'll need functions from code snippet for the normal distributions CDF and PDF. Download the code on OnePageCode Substack. This code snippet function takes the GP's predicted mean, code snippet, and standard deviation, code snippet, for candidate point, along with the current best observed function value, code snippet. It computes the normalized improvement code snippet and then uses the CDF and PDF of the standard normal distribution to combine these values into the final code snippet score. The code snippet ensures numerical stability when the predicted uncertainty is very small. To illustrate, let's consider a simple numerical example. Suppose our current best observed value code snippet is 5.0. We are evaluating two candidate points, code snippet and code snippet. Download the code on OnePageCode Substack. In this example, code snippet has a mean that is not the lowest, but its high uncertainty gives it a good code snippet score, indicating strong exploration potential. Code snippet has a mean very close to code snippet and low uncertainty, leading to a low code snippet because it's unlikely to offer significant improvement. Code snippet has a very promising mean and moderate uncertainty, resulting in a high code snippet due to its strong exploitation potential. This demonstrates how code snippet balances both aspects. Upper confidence bound, UCB. The upper confidence bound, code snippet, acquisition function directly combines the mean prediction and the uncertainty, typically for maximization problems. For a minimization problem, we would use a lower confidence bound, code snippet. The code snippet strategy aims to select points that have a high predicted mean and high uncertainty, promoting both exploitation and exploration. The intuition is to be optimistic in the face of uncertainty. If a region has a high predicted value, exploitation, or a high uncertainty, exploration, because it might contain a very good value, code snippet will favor it. The parameter code snippet, or code snippet in some literature, controls the trade-off, a larger code snippet emphasizes exploration, while a smaller code snippet emphasizes exploitation. The mathematical formulation for upper confidence bound for a maximization problem is $. X równa się mu x plus kappa sigma x $, where code snippet, the predicted mean of the objective function at point code snippet from the Gaussian process. Code snippet, the predicted standard deviation of the objective function at point code snippet from the Gaussian process. Code snippet, a non-negative hyperparameter that balances exploration and exploitation. For minimization problem, we would generally use the lower confidence bound, code snippet. $. X równa się mu x kappa sigma x $. Since Bayesian optimization typically frames problems as maximization of the acquisition function, even for minimization of the objective, we usually maximize code snippet, which is inherently for minimization, or maximize code snippet for maximization problems, or minimize code snippet for minimization problems. For consistency with the code snippet example, let's consider code snippet for a minimization objective. Download the code on OnePageCode Substack. The code snippet function is simpler than code snippet, directly combining the mean and standard deviation. The code snippet parameter is crucial here, allowing us to tune the balance. Let's use a numerical example for code snippet. Again, we're looking for the minimum. Download the code on OnePageCode Substack. In this code snippet example, a lower code snip, ET value is better. Code snippet has a relatively low code snippet due to its high uncertainty, making it an attractive point for exploration. Code snippet has a high code snippet, making it less attractive. Code snippet has the lowest code snippet because of its promising mean and moderate uncertainty, indicating it's a strong candidate for exploitation. The inner optimization problem. Maximizing the acquisition function. Once an acquisition function is defined, the next step in Bayesian optimization is to find the point code snippet in the search space that maximizes this acquisition function. This is itself an optimization problem, often referred to as the inner optimization problem. $x next equals \arg \max x and \mathgal x \alpha x where code snippet is the chosen acquisition function, e.g., code snippet or code snippet. Why is it cheap to evaluate? Unlike the original black box objective function, the acquisition function is cheap to evaluate. Its computation relies solely on the Gaussian process's predicted mean and variance, which are analytical expressions derived from the GP model. We don't need to run a complex simulation, train a neural network, or execute a trading strategy to calculate code snippet. This allows us to evaluate the acquisition function thousands or even millions of times to find its maximum without incurring significant computational cost. Algorithms for maximizing acquisition functions. Since the acquisition function is typically non-convex and can have multiple local optima, a global optimization algorithm is often preferred for its maximization. Common approaches include 1. Gradient-based methods, with multiple restarts algorithms like LBFGSB or SLSQP from code snippet can be used. To mitigate getting stuck in local optima, these methods are often run from multiple randomly sampled starting points across the search space. 2. Global optimization algorithms. Direct search methods, e.g., code snippet or code snippet. These are designed to find global optima. Evolutionary algorithms, genetic algorithms, or particle swarm optimization can also be effective. 3. Grid search or random search. For low-dimensional problems, a dense grid search or a large number of random samples can be used to approximate the maximum. Let's demonstrate how to use code snippet, which can be used for maximization by minimizing the negative of the function, with multiple restarts to find the maximum of an acquisition function. For this example, we'll need a mock GP function that provides code snippet and code snippet for any code snippet. Download the code on OnePatchCode Substack. This code snippet demonstrates the inner optimization problem. We define a code snippet, which wraps our code snippet function and returns its negative as code snippet finds minimums. We then run code snippet from multiple random starting points, code snippet, within the defined code snippet. This multi-start strategy helps increase the chances of finding the global maximum of the acquisition function, which is crucial for efficient Bayesian optimization. The code snippet function simulates the output of a real GP model for demonstration purposes. Choosing an acquisition function. The choice of acquisition function impacts the balance between exploration and exploitation and can significantly affect the efficiency of the Bayesian optimization process. Expected improvement, EI, often a good default. It tends to be more exploitative, focusing on regions likely to yield immediate improvements. It's particularly useful when the cost of evaluation is high and you want to converge quickly. Upper confidence bound, UCB, / lower confidence bound, LCB, more explicitly tunable via the code snippet parameter. Large code snippet favors exploration, suitable for early stages of optimization or when the search space is largely unknown. It's optimistic in the face of uncertainty, trying out points with high variance. Small code snippet favors exploitation, suitable for later stages when you want to refine the optimum. It places more weight on the mean prediction. Probability of improvement, PI, similar to EI, but simpler. It only considers the probability that a point code snippet will improve upon code snippet. It doesn't quantify the magnitude of improvement, making it less effective than EI in practice, as it can be too conservative, exploitative. Entropy search, ES, / predictive entropy search, PES, more advanced. Acquisition functions that aim to reduce the uncertainty of the location of the global optimum. These are computationally more expensive, but can be very efficient in higher dimensions. Practical implications. EI versus UCB. Code snippet is often preferred for its clear interpretation, expected gain, and robust performance. Code snippet offers direct control over the exploration-exploitation balance via code snippet, which can be decayed over iterations, e.g., starting with a high code snippet and gradually reducing it to shift from exploration to exploitation. Computational considerations in higher dimensions. As the dimensionality of the search space increases, maximizing the acquisition function becomes more challenging. The code snippet problem for code snippet becomes harder, requiring more sophisticated global optimization techniques and more restarts. The curse of dimensionality means that even with intelligent sampling, the search space can be vast, making it difficult to find the global optimum of the acquisition function efficiently. This is a primary limitation of standard Bayesian optimization in very high-dimensional settings, e.g., 20-30 dimensions, leading to research in specialized high-dimensional BO methods. Regret metrics, evaluating optimization progress. To assess the quality of an optimization algorithm or a specific acquisition function policy, we often use regret metrics. These metrics quantify how much worse our algorithm performs compared to an ideal scenario where we immediately knew the true optimum. 1. Instant regret or simple regret. The instant regret at iteration code snippet is the difference between the true optimal value code snippet and the best observed value code snippet up to that iteration. RTFT best $. For minimization. For maximization, it would be code snippet. This metric tells us how close our current best solution is to the global optimum at any given point in time. It measures the quality of the solution found so far. 2. Cumulative regret. The cumulative regret at iteration code snippet is the sum of the differences between the value of the function evaluated at each chosen point code snippet and the true optimal value code snippet. CRT equals \sum. T equals 1 caret T, FXT, FOPT. For minimization. This metric measures the efficiency of the optimization process. A lower cumulative regret indicates that the algorithm made better choices on average throughout the optimization, incurring less cost or loss over time. In financial trading, this could represent the total opportunity cost of not always picking the theoretically optimal strategy parameters. These regret metrics are primarily theoretical tools for analyzing and comparing optimization algorithms. In real-world black box optimization, code snippet is unknown, so we often plot the code snippet found so far, or code snippet, over iterations to visualize convergence. Putting it all together, a toy exa. Ample walkthrough. Let's conceptualize one full iteration of Bayesian optimization for a 1D problem, explicitly showing how the GP updates and the acquisition function guides the next sample. Suppose we want to find the minimum of an unknown function code snippet over the range code snippet. Step 1. Initial observations. We start with a few initial, randomly sampled observations of code snippet. These points form our initial training data for the Gaussian process. Code snippet, e.g. code snippet, e.g. code snippet. Step 2. Fit a Gaussian process. We fit a Gaussian process model to our observed data code snippet. This GP now provides us with a probabilistic surrogate model of code snippet. For any unobserved point code snippet, we can query the GP for its predicted mean code snippet and standard deviation code snippet. Conceptual visualization. Imagine a plot with the observed points, the GP's mean function, a curve passing through or near the points, and a shaded region representing the uncertainty, e.g., code snippet. Step 3. Calculate and maximize the acquisition function. Now we choose an acquisition function, say expected improvement code snippet. We evaluate code snippet across a grid of candidate points in our search space, or, more efficiently, use an optimizer like code snippet with multiple restarts. For each candidate code snippet in code snippet. 1. Query the GP, code snippet. 2. Calculate code snippet using code snippet code. Snippet and code snippet. The goal is to find code snippet. This code snippet will be the point where the code snippet curve peaks. Conceptual visualization. Overlay a new curve on the plot, the code snippet function. This curve will typically have peaks in two types of regions. Near code snippet, where code snippet is low, exploitation. In areas with high code snippet, high uncertainty. Even if code snippet is not particularly low, exploration. The highest point on the code snippet curve dictates where the algorithm proposes to sample next. For instance, if code snippet peaks at code snippet, then code snippet. Step 4. Evaluate the objective function at code snippet. We then evaluate the true, expensive objective function code snippet at code snippet. Code snippet. Step 5. Update observations and repeat. Add the new observation code snippet to our code snippet and code snippet datasets. Update code snippet if code snippet is better. Then, return to step 2. Refit the Gaussian process with the updated data. Conceptual visualization. When the GP is refitted with a new point code snippet, the GP's mean function will now pass through this new point, and its uncertainty, variance, will collapse to 0 at code snippet. This change in the GP posterior will, in turn, alter the acquisition function curve, shifting its peaks to new promising regions, and the cycle continues. This iterative process of model fitting, acquisition function maximization, and objective function evaluation is the core loop of Bayesian optimization, intelligently navigating the search space to find the optimum with minimal expensive function calls. Acquisition function, expected improvement, EI, and upper confidence bound, UCB. Acquisition functions are the critical decision-making engine within a Bayesian optimization loop. After a Gaussian process, GP, model has been updated with new observations. It provides a probabilistic estimate, mean and variance, for the objective function across the entire search space. The acquisition function takes these probabilistic estimates and quantifies the utility or desirability of evaluating the objective function at any given candidate point. Its primary role is to judiciously balance exploration, sampling uncertain regions to reduce uncertainty, and exploitation, sampling regions with high expected objective values to find the optimum. The core principle, balancing exploration and exploitation. In the context of optimizing trading strategies, we often face a black box function where each evaluation, e.g., backtesting a strategy with a new set of parameters, is computationally expensive. We want to find the optimal parameters with the fewest possible evaluations. This necessitates a strategic approach. Exploitation, focusing on areas where the Gaussian process predicts high objective values, e.g., high Sharpe ratio, low drawdown. This aims to quickly converge to the best-known performance. Exploration, investigating areas where the Gaussian process is highly uncertain. This is crucial to avoid getting stuck in local optima and to discover potentially better, unobserved regions of the parameter space. Acquisition functions provide a principled way to quantify this trade-off, guiding the search towards the global optimum efficiently. Expected improvement, EI. Expected improvement, EI, is one of the most widely used acquisition functions. Its core idea is to select the next point that is expected to yield the largest improvement over the current best observed value. Conceptual foundation of EI. Imagine we've already run our trading strategy with several parameter sets, and the best performance we've achieved so far is code snippet. EI evaluates how much on average we expect to improve upon code snippet if we were to sample at a new candidate point code snippet. Any performance worse than code snippet contributes 0 improvement, while any better performance contributes code snippet. This concept is inherently linked to the idea of a positive improvement, often expressed as code snippet. Since code snippet is a random variable according to our Gaussian process posterior, we cannot know code snippet directly. Instead, we compute the expectation of this improvement over the GP's predictive distribution at code snippet. Mathematical formulation of EI. Let code snippet be the maximum objective value observed so far, or the minimum if minimizing. For a candidate point code snippet, let code snippet and code snippet be the mean and standard deviation of the Gaussian process posterior predictive distribution at code snippet. The expected. Improvement code snippet is given by code snippet, or code snippet. Here, code snippet, the posterior mean prediction of the objective function at code snippet. Code snippet, the posterior standard deviation prediction of the objective function at code snippet. Code snippet, the best observed value of the objective function so far. For maximization problems, this is code snippet. Code snippet 11, an optional exploration-exploitation trade-off parameter, typically a small non-negative value, e.g. 0.01. A larger code snippet encourages more exploration by requiring a higher improvement threshold, often set to 0 for a greedy approach. Code snippet, the cumulative distribution function, CDF, of the standard normal distribution evaluated at code snippet. This represents the probability that the true function value code snippet at point code snippet will be greater than code snippet. In simpler terms, it's the probability of achieving an improvement. Code snippet, the probability density function, PDF, of the standard normal distribution evaluated at code snippet. This term accounts for the magnitude of the expected improvement if improvement occurs. The product code snippet captures the contribution from points that are likely to improve, weighted by their distance from the current best. The term code snippet captures the contribution from points whose mean is not necessarily above the current best, but whose uncertainty, large code snippet, allows for a significant positive tail. Together, they form the expected value of code snippet. The standard derivation of EI assumes a noise-free objective function. However, in practical applications like optimizing trading strategies, noise is inherent. If the Gaussian process model itself accounts for observation noise, e.g., through a nugget term in the kernel, then code snippet already reflects the total uncertainty, epistemic and aleatoric. In such cases, the code snippet used in the EI formula implicitly incorporates the noise. If the GP does not model noise, one might consider adjusting code snippet or code snippet to account for it, or simply accept that EI is providing an expectation over the underlying latent function. Code implementation for expected improvement. Let's implement the EI function in Python. We'll need code snippet for numerical operations and code snippet for the standard normal CDF and PDF. Download the code on one patch code Substack. The code snippet function takes the GP's predicted mean, code snippet, and standard deviation, code snippet, for a set of candidate points, along with the code snippet value and the exploration parameter code snippet. It then calculates code snippet and uses code snippet and code snippet to compute the code snippet and code snippet terms, respectively. The code snippet context manager and the code snippet line ensure robust handling of cases where the GP predicts zero uncertainty, e.g., at an observed point, where EI should naturally be zero. Let's demonstrate with a simple numerical example. Suppose our GP predicts a mean and standard deviation for 3 candidate trading strategy parameter sets, and our current best Sharpe ratio observed is code snippet. Download the code on one patch code Substack. In this example, the output code snippet will show which candidate point has the highest expected improvement, guiding our next backtest. Notice how the second candidate, despite having a lower mean than the third, might have a higher EI due to its significantly larger standard deviation, promoting exploration. Upper confidence bound, UCB. The upper confidence bound, UCB, acquisition function offers a more direct approach to balancing exploration and exploitation. It is based on the principle of optimism in the face of uncertainty. Conceptual foundation of UCB. UCB constructs an optimistic estimate of the objective function value by adding a scaled version of the uncertainty to the mean prediction. The idea is to prioritize points that either have a high predicted mean, exploitation, or high uncertainty, exploration. For a candidate point code snippet, UCB calculates a score by taking the posterior mean code snippet and adding code snippet times the posterior standard deviation code snippet. Mathematical formulation of UCB. Code snippet. Here, code snippet, the posterior mean prediction of the objective function at code snippet. Code snippet, the posterior standard dev. Bayesian prediction of the objective function at code snippet. Code snippet, beta, a non-negative hyperparameter that controls the exploration-exploitation trade-off. A larger code snippet places more emphasis on exploration, uncertainty, while smaller code snippet focuses more on exploitation mean. Choosing and tuning the code snippet hyperparameter. The code snippet parameter is crucial for UCB's performance. Its value often depends on the problem and the stage of optimization. Small code snippet, e.g., 0.1 to 0.5, lead to more exploitative behavior, favoring points with high expected values. Useful when you're confident about the search space and want to refine an already good solution. Large code snippet, e.g., 2.0 to 5.0, leads to more explorative behavior, prioritizing points with high uncertainty. Useful in the early stages of optimization or when the search space is largely unknown to avoid getting stuck in local optima. In many implementations, code snippet is not a fixed constant, but changes over iterations, often increasing with the number of observations to encourage more exploration as the model becomes more certain in certain regions. A common dynamic code snippet is often proportional to code snippet, where code snippet is the current iteration count and code snippet relates to the dimensionality of the space or number of observations. For practical trading strategy optimization, one might initially set a higher code snippet to broadly skin the parameter space, then gradually reduce it to fine-tune around promising regions. Code implementation for upper confidence bound. Implementing UCB is straightforward given its simple formula. Download the code on one patch code substack. This code snippet function directly applies the formula, combining the mean and standard deviation weighted by code snippet. Let's use the same numerical example as for EI to compare. Download the code on one patch code substack. Observe how changing code snippet influences the selected point. A higher code snippet might favor the second candidate, high code snippet, while a lower code snippet might favor the third, high code snippet, lower code snippet. This demonstrates the direct control code snippet provides over the exploration-exploitation balance. Comparing EI and UCB. Both EI and UCB are effective acquisition functions, but they encode the exploration-exploitation trade-off differently. EI, expected improvement, focuses on the expected gain over the current best. It is often preferred for problems where maximizing a specific improvement is the primary goal. It naturally balances exploration and exploitation. Points with high mean, exploitation, or high uncertainty, exploration, leading to a higher chance of improvement, will have high EI. It can be more sensitive to the code snippet value. UCB, upper confidence bound, focuses on an optimistic estimate of the objective value. It is more explicitly controlled by the code snippet parameter, offering intuitive tuning of the exploration-exploitation balance. It can be more robust to noisy objectives and encourages broader exploration. In the context of optimizing trading strategies, both can be viable. EI might be suitable when you have a clear target performance, e.g., a minimum Sharpe ratio, and want to efficiently surpass it. UCB might be better for exploring a wide range of parameter combinations, especially in early stages, to ensure you don't miss out on globally optimal regions that might initially appear less promising. Both EI and UCB are considered myopic acquisition functions, meaning they only consider the immediate next step. They don't plan multiple steps ahead. While this simplifies computation, it means they might not always find the most globally optimal path in very complex landscapes. However, for most practical Bayesian optimization applications, their efficiency and effectiveness make them excellent choices. Visualizing acquisition functions. Visualizing the acquisition function alongside the Gaussian process mean and credible intervals is incredibly insightful. It clearly shows how the acquisition function identifies the next sampling point by combining the G-piece knowledge. For a 1D objective function, we can plot 1. The observed data points. 2. The G-piece posterior mean, code snippet. 3. The G-piece credible interval, code snippet. 4. The acquisition function values, EI or UCB. 5. Highlight the point code snippet that maximizes TH. The acquisition function. Let's set up a simple simulation for a 1D GP to demonstrate this. We'll simulate GP predictions rather than building a full GP model for brevity, focusing on the acquisition function's behavior. Download the code on OnePageCode Substack. The visualization code first simulates GP mean and standard deviation across a 1D range. It then calculates EI and UCB values and plots them. Notice how the acquisition functions peak either in regions where the mean is high, exploitation, or where the uncertainty, credible interval, is wide, exploration. The code snippet marker indicates the point chosen for the next evaluation by the respective acquisition function. This visual representation is crucial for understanding how these functions guide the search. The acquisition process, finding the next best point. Once an acquisition function, like EI or UCB, has been defined, the next step in the Bayesian optimization loop is to find the point code snippet in the search space that maximizes this function. Code snippet. Since acquisition functions are typically nonconvex, maximizing them often requires global optimization techniques. Common approaches include multi-start optimization, starting a local optimizer, e.g., LBFGSB from code snippet, from multiple randomly chosen points in the search space, as well as from the best-known point from previous observations. This helps mitigate the risk of getting stuck in a poor local optimum of the acquisition function. On genetic algorithms or evolutionary strategies. These global optimization algorithms are well suited for non-convex landscapes and can explore the acquisition function surface effectively. Random search. For very high-dimensional problems, a simple random search over a large number of candidate points might be surprisingly effective, especially if the acquisition function has many local optima. The chosen code snippet is then evaluated by running the expensive black box function, e.g., backtesting the trading strategy with the new parameters. The resulting objective value code snippet is then added to the observed data, and the Gaussian process model is updated, completing one iteration of the Bayesian optimization loop. Minimal end-to-end Bayesian optimization loop snippet. Here's a conceptual Python snippet illustrating the flow of a single Bayesian optimization iteration, integrating the acquisition function. Download the code on OnePageCode Substack. This snippet provides a high-level overview of how the components fit together. The code snippet and code snippet are placeholders. In a real quant trading setup, code snippet would be a complex backtesting engine, and code snippet would be a robust, carefully constructed Gaussian process. Other acquisition functions. While EI and UCB are among the most popular and generally effective acquisition functions, the field of Bayesian optimization has developed many others, each with different strengths and weaknesses. Probability of improvement. PI similar to EI, but simpler. It only considers the probability that code snippet will be greater than code snippet. It tends to be more exploitative than EI. Entropy search, ES/predictive entropy search, PES. These functions aim to reduce the uncertainty about the location of the optimum. They are more computationally intensive, but can be very effective, especially in higher dimensions. Knowledge gradient, KG. This function directly estimates the expected value of obtaining additional information at a given point, taking into account how that information will improve the final decision. Thompson sampling, TS, a non-parametric approach that samples functions from the GP posterior and evaluates the maximum of these samples. It's often simple to implement and performs well. Understanding EI and UCB provides a strong foundation for applying Bayesian optimization and for appreciating the nuances of these more advanced acquisition strategies. The full BO loop, orchestrating Bayesian optimization. Bayesian optimization, BO, is an iterative, sample-efficient strategy for optimizing expensive black box functions. It operates by building a probabilistic model, the Gaussian process, of the objective function, and then using an acquisition function to determine the most promising next sample location. This section synthesizes these core components into a complete, actionable workflow, often referred to as the BO loop. Policy and environment in BO. Before diving into the loop, it's crucial to understand the two primary conceptual entities at play. The environment. This refers to the black box function we're trying to optimize. In quantitative finance, this is typically a trading strategy's performance evaluation, e.g., Sharpe ratio, Sortino ratio, maximum drawdown, given a set of parameters, evaluated via backtester. The environment is black box because we don't have an explicit mathematical formula for its output, and its evaluations can be costly, time-consuming backtests, and potentially noisy. The policy. This is the Bayesian optimization algorithm itself. It encompasses the Gaussian process model, the acquisition function, and a logic that orchestrates their interaction to suggest new points. The policy is continuously refined and learns about the environment by incorporating new observations, enabling it to make progressively better decisions about where to sample next. The iterative Bayesian optimization process. The BO loop is a sequential decision-making process. Each iteration refines our understanding of the objective function and guides us toward the optimum. Here's a step-by-step breakdown. 1. Initialization. Begin by sampling a small set of initial points from the parameter space, e.g., 5 to 10 points chosen randomly or using a Latin hypercube sampling scheme. Evaluate the objective function, the environment, at these initial points to obtain corresponding performance metrics. These initial observations form the starting data set. $D equals \x1, y1, \dots, xn, yn, $. 2. Model fitting, Gaussian process update. Fit a Gaussian process, GP, model to the current dataset $D. The GP learns the relationship between the input parameters $x and the observed performance $y. Why GP? The GP is critical because it provides not just a prediction of the objective function's value at unobserved points, but also a measure of uncertainty around that prediction. This uncertainty quantification is fundamental for balancing exploration and exploitation. 3. Acquisition function calculation. Based on the fitted GP, calculate the value of the chosen acquisition function, e.g., expected improvement, upper confidence bound, across the entire parameter space. Why acquisition function? The acquisition function translates the GP's predictions, mean and variance, into a single, actionable score that quantifies the desirability of sampling a particular point. It explicitly balances the trade-off between exploitation, sampling points predicted to have high objective values, areas where the current model believes the optimum might be. Exploration, sampling points where the model's uncertainty is high, areas that are poorly understood and might reveal a new global optimum. 4. Acquisition function maximization, inner optimization. Find the point $x next to $, in the parameter space that maximizes the acquisition function's value. This is typically a much cheaper optimization problem than evaluating the original black box function. How is it solved? This inner optimization problem is usually solved using standard optimization techniques, as the acquisition function's analytical form is known, derived from the GP. Common methods include gradient-based methods. If the acquisition function is differentiable, methods like LBF-GSB can be used. This usually involves starting from multiple random points, multi-start optimization, to avoid local optima. Global optimization algorithms. Algorithms like differential evolution or even simple random search can be employed, especially for non-differentiable or highly multimodal acquisition functions. For most practical BO libraries, multi-start LBF-GSB is a common choice. 5. Objective function evaluation. Evaluate the true black box objective function, the environment, at the newly proposed point $x next $. This yields a new observation $y next $. This is the most expensive step in the loop, as it involves running the full trading strategy backtest or a complex simulation. 6. Dataset update. Add the new observation $x next, y next, $, to the dataset $d. 7. Termination check. Check if a predefined stopping criterion has been met. If not, return to step 2 for the next iteration. The noisy observation model in quant finance. In the context of optimizing trading strategies, the observations $y next dollar, e.g., the Sharpe ratio from a backtest, are inherently noisy. This noise can stem from several sources. Market fluctuations. Even with the same strategy parameters, running a backtest over slightly different historical periods, e.g., shifting the window by a day, can yield different performance metrics due to market randomness. Data quality. Imperfections in historical data, missing ticks, erroneous quotes, can introduce noise. Stochastic elements. Some trading strategies might incorporate stochastic elements, e.g., Monte Carlo simulations for risk assessment, leading to variability in results. Backtesting framework limitations. Simplified models or assumptions within the backtesting environment can contribute to observed noise. The Gaussian process, with its ability to model noise through its likelihood function, is well suited to handle these noisy observations, providing more robust predictions and uncertainty estimates. Stopping criteria for the BO loop. The BO loop continues until a certain condition is met. Common stopping criteria include budget X. Gaussian. The most common criterion is a fixed number of iterations or objective function evaluations. For example, run BO for 50 backtests. Performance threshold. Stop when the best observed objective value reaches a predefined target, e.g., stop when Sharpe ratio greater than 1.5. No significant improvement. Terminate if the best observed value hasn't improved by a significant margin over a certain number of consecutive iterations. This prevents wasting resources if the algorithm has converged or is stuck. Time limit. Stop if a maximum computation time has been exceeded. This is crucial for real-time or time-sensitive optimization tasks. Convergence of acquisition function. Stop if the acquisition function's maximum value drops below a certain threshold, indicating that there are no longer highly promising regions to explore. Illustrative walkthrough. Optimizing moving average parameters. Let's consider optimizing the short and long window lengths for a simple moving average crossover strategy to maximize its Sharpe ratio. Our objective function is code snippet. Iteration 1, conceptual. 1. Initial samples. We start with a few random code snippet pairs and run backtests. Code snippet -Sharpe 0.8. Code snippet -Sharpe 0.5. Code snippet -Sharpe 1.1 current best. 2. GP update. The GP is fitted to these 3 points. It now has an initial probabilistic understanding of the Sharpe ratio landscape. 3. AF calculation. The acquisition function, e.g., EI, is computed. It suggests regions where the Sharpe ratio is likely high or where the uncertainty is significant. 4. AF maximization. The point code snippet is found to maximize the acquisition function. It might be close to code snippet exploitation or in a less explored area with high uncertainty exploration. 5. Evaluation. We run a backtest with code snippet. Code snippet -Sharpe 1.25. 6. Dataset update. The dataset now includes code snippet with Sharpe 1.25. The current best is 1.25. 7. Termination check. Budget not exhausted. Continue. Iteration 2, conceptual. 1. GP update. The GP is refitted with the expanded dataset, including code snippet. Its predictions and uncertainties are more refined. 2. AF calculation. A new acquisition function landscape emerges. 3. AF maximization. The acquisition function now suggests code snippet as the next point. Perhaps the GP's uncertainty reduced around code snippet, and code snippet is a new promising area. 4. Evaluation. We run a backtest with code snippet. Code snippet -Sharpe 1.18. 5. Dataset update. The dataset now includes code snippet with Sharpe 1.18. The current best remains 1.25. 6. Termination check. Budget not exhausted. Continue. This iterative process continues, with each new observation helping the GP model become more accurate and the acquisition function guiding the search more effectively towards the global optimum. Practical implementation of the BO loop. To illustrate the BO loop, we'll use a simplified setup. We'll define a dummy objective function and simulate the Gaussian process and acquisition function components. 1. Defining the objective function. First, let's define our code snippet, the environment we want to optimize. For simplicity, we'll use a 1D function with some added noise, mimicking the variability in real-world backtest results. Download the code on OnePageCode Substack. This code defines a simple one-dimensional function code snippet that we aim to maximize. It simulates a black box scenario by including random noise, making it difficult to find the exact optimum through direct analytical methods. The conceptual maximum for the true function is that code snippet. 2. Initializing the Bayesian optimization policy. We need initial data points to start building our Gaussian process model. This involves selecting a few points within our search space and evaluating them using the code snippet. Download the code on OnePageCode Substack. Here, we set up the code snippet for our single parameter code snippet. We then generate code snippet random points within these bounds, evaluate them with our code snippet, and store them as code snippet and code snippet. Finally, we initialize the code snippet from code snippet, setting up a code snippet which defines the assumed smoothness and shape of our objective function. Code snippet handles noise and observations, and code snippet helps with numerical stability. 3. Defining the acquisition function. Now, we define the code snip. TEI, acquisition function. This function will guide our search, balancing exploration and exploitation based on the GP's predictions. Download the code on OnePageCode Substack. This code snippet function takes candidate points, the current GP model, and the best observed value, code snippet, to calculate the EI. The code snippet parameter allows us to fine-tune the exploration-exploitation balance. A higher code snippet encourages more exploration. The formula for EI is based on the cumulative distribution function, CDF, and probability density function, PDF, of the normal distribution, reflecting the probability of improvement weighted by the magnitude of that improvement. 4. Maximizing the acquisition function. This is the inner optimization step. We need to find the code snippet that maximizes the code snippet function. Since code snippet performs minimization, we will minimize the negative of the EI. Download the code on OnePageCode Substack. The code snippet function employs a common strategy, code snippet. It runs the code snippet using the LBFGSB method for bounded optimization multiple times, each time starting from a different random initial point. This helps to overcome the problem of local optima when maximizing the acquisition function, ensuring we find a truly promising next sample location. We minimize the negative of the acquisition function because code snippet is designed for minimization. 5. The main Bayesian optimization loop. Now we integrate all components into the full iterative loop. Download the code on OnePageCode Substack. This code block encapsulates the core BO loop. In each iteration, 1. The code snippet is code snippet, updated with all current observations, code snippet, code snippet. 2. Code snippet is called to find the most promising code snippet by maximizing the acquisition function. 3. The actual code snippet is called with code snippet to get code snippet. This simulates the expensive black box evaluation. 4. The new code snippet pair is added to the code snippet and code snippet datasets. 5. Progress is printed, showing the proposed point, its observed value, and the overall best found so far. 6. The loop continues for code snippet, which acts as our simple budget-based stopping criterion. This complete code effectively demonstrates the full iterative process of Bayesian optimization, from initial sampling and model fitting to acquisition function-driven search and dataset updates, culminating in an optimized solution. While simplified, it provides a robust conceptual and practical foundation for understanding how BO works in real-world applications like quantitative trading strategy parameter optimization. Optimizing the pairs trading strategy. Introduction to strategy optimization with Bayesian optimization. In previous sections, we established Bayesian optimization, BO, as a powerful framework for optimizing expensive black box functions. We explored its core components, including the surrogate model, Gaussian process, and acquisition functions, expected improvement, upper confidence bound. While our prior discussions might have alluded to simpler strategies, such as basic trend-following approaches, the true power of BO shines when applied to more complex, real-world financial strategies where parameter tuning is critical but resource-intensive. Pairs trading, a market-neutral arbitrage strategy, serves as an excellent candidate for demonstrating BO's practical utility. Unlike simple trend-following strategies that might rely on a single moving average crossover, pairs trading often involves multiple parameters that dictate entry and exit conditions, risk management, and position sizing. These parameters interact in complex ways, making exhaustive grid searches or random searches computationally prohibitive. Why Bayesian optimization for pairs trading? The objective function for optimizing a pairs trading strategy. Typically, it's backtested performance metric like the Sharpe ratio or maximum drawdown. Exhibits characteristics that make it ideal for Bayesian optimization. Expensive to evaluate. Each evaluation of the objective function requires a full backtest of the straw. Teggy over historical data, which can be computationally intensive, especially for large data sets or complex strategy logic. Running thousands of backtests to find optimal parameters is often impractical. Black box nature. The relationship between the input parameters, e.g., entry/exit thresholds, and the output performance metric is not easily expressed as a simple mathematical formula. It's a result of complex interactions within the backtesting engine, making gradient-based optimization difficult or impossible. Noisy. Financial market data inherently contains noise. A strategy's performance on historical data can also be influenced by the specific data period or micro-market events, making the objective function potentially noisy. BO's probabilistic approach can handle this noise. Nonconvex. The performance landscape parameters versus Sharpe ratio is highly likely to be nonconvex, meaning it has multiple local optima. BO's ability to balance exploration, searching new, potentially promising areas, and exploitation, refining known good areas, helps navigate such complex landscapes effectively, increasing the chances of finding a global optimum. By applying BO, we aim to systematically discover optimal or near-optimal parameter configurations that maximize our desired performance metric, all while minimizing the number of costly backtest evaluations. Understanding pairs trading parameters. At its core, pairs trading involves identifying two historically correlated assets, e.g., two stocks in the same industry, or an ETF and its underlying index, whose price relationship temporarily deviates from its historical norm. The strategy then involves going long the underperforming asset and short the overperforming asset, betting on the convergence of their prices back to their equilibrium. This is often done by analyzing the spread between the two assets, which would be the difference in their prices or the ratio of their prices. Key parameters that govern a pair's trading strategy often include look-back period for co-integration/correlation. The number of historical data points used to establish the statistical relationship, e.g., co-integration or correlation, between the two assets. A shorter period might be more adaptive, while a longer period provides more statistical stability. Entry thresholds. These define how far the spread must deviate from its historical mean before a trade is initiated. This deviation is commonly measured in standard deviations, often referred to as z-scores. For example, a common rule is to enter when the z-score of the spread is above 2.0 or below -2.0. These thresholds determine the sensitivity of the strategy to price divergences. A higher threshold means fewer trades, but potentially stronger mean reversion signals. Exit thresholds. These define when to close an open position. This could be when the spread reverts to its mean, z-score near zero, or when it crosses a smaller threshold, e.g., z-score below 0.5, or even a specific profit target or stop-loss level. The exit threshold dictates how long positions are held and how much profit is targeted before closing. Stop loss/take profit levels. Specific price or spread deviation levels at which to close a trade to limit losses or lock in profits, regardless of the mean reversion signal. Our objective will be to find the optimal combination of these entry and exit thresholds and potentially other parameters that yields the best performance for the pair's trading strategy over a given historical period. This performance will typically be quantified by a robust metric like the Sharpe ratio, which measures risk-adjusted returns by dividing the strategy's excess return above the risk-free rate, by its standard deviation of returns. Maximizing the Sharpe ratio means finding a balance between high returns and low volatility, which is a primary goal for many quantitative traders. Setting up the environment. Before we can implement and optimize our pair's trading strategy, we need to set up our Python environment by installing the necessary libraries and ensuring reproducibility of our results. Installing required libraries. We will primarily use CodeSnippet for Bayesian optimization and CodeSnippet for convenient access to historical financial data. CodeSnippet is built on PyTorch, leveraging its capabilities for automatic differentiation and potential GPU acceleration, making it a robust choice for complex optimization problems. CodeSnippet provides a simple, free interface to download historical stock data from yfinance, which is ideal for educational and research purposes. For interactive environments like Jupyter Notebooks, you can install packages directly using the CodeSnippet prefix. Download the code on OnePageCode Substack. This command uses CodeSnippet, Python's standard package installer, to download and install the specified libraries into your current Python environment. The CodeSnippet prefix allows execution of shell commands directly from a Jupyter Notebook cell. CodeSnippet brings along its dependencies, including CodeSnippet, PyTorch, CodeSnippet, and CodeSnippet, which are essential for its functionality. CodeSnippet is a lightweight library specifically designed for financial data acquisition. Importing essential modules. After installation, we import the necessary Python libraries. It's good practice to import all required modules at the beginning of your script or notebook, and to use conventional aliases for commonly used libraries, e.g., CodeSnippet for CodeSnippet, CodeSnippet for CodeSnippet, to improve code readability and brevity. Download the code on OnePageCode Substack. This block imports a comprehensive set of libraries. CodeSnippet, and CodeSnippet are fundamental for numerical and data operations in Python. CodeSnippet is specific for financial data acquisition. CodeSnippet and CodeSnippet are essential for plotting and visualization. The CodeSnippet and CodeSnippet imports are central to our Bayesian optimization setup, bringing in components like CodeSnippet for our surrogate model, CodeSnippet as an acquisition function, and utility functions for model fitting and optimization. Each inline comment clarifies the primary purpose of the imported module or class, aiding in immediate understanding. Ensuring reproducibility with random seeds. Reproducibility is paramount in quantitative finance and scientific research. Many algorithms, especially those involving simulations, machine learning, or optimization, like Bayesian optimization, rely on pseudo-random number generators. If these generators are not initialized with a consistent seed, running the same code multiple times will yield different results, making it difficult to debug, compare findings, or verify experiments. To ensure that our experiments are reproducible, we explicitly set the random seeds for Python's built-in code snippet module, CodeSnippet, and CodeSnippet. This ensures that any subsequent operations that rely on random numbers will produce the exact same sequence of random values each time the code is executed with the same seed. Download the code on OnePageCode Substack. Here, we define a CodeSnippet variable, typically an arbitrary integer like CodeSnippet. This seed is then passed to the CodeSnippet or CodeSnippet functions of CodeSnippet, and CodeSnippet. This simple yet crucial EP guarantees that our experiments, from initial data sampling to model training and acquisition function optimization, will yield consistent results across different runs, provided the environment and code remain unchanged. This consistency is vital for debugging, comparing different optimization runs, and validating our methodology. With the environment set up and reproducibility ensured, we are now ready to proceed with defining our pair's trading strategy, implementing its backtesting logic, and integrating it as the black box objective function for Bayesian optimization in the subsequent sections. A placeholder for this objective function would conceptually look something like this, taking parameters and returning a performance metric. Download the code on one patch code Substack. This code snippet function conceptually represents the black box objective we will optimize. It takes a code snippet of parameters, e.g., entry and exit thresholds, and is expected to return a code snippet representing the strategy's performance, such as its Sharpe ratio. The actual implementation of this function, including data acquisition, spread calculation, and detailed backtesting logic, will be the focus of the next section, building upon the foundational setup established here. Formulating the objective function, the black box strategy. Bayesian optimization operates by efficiently exploring a search space to find the optimal inputs for a given objective function. A key characteristic of this objective function is that it behaves like a black box. The optimizer doesn't need to know its internal mechanics or mathematical form. It simply provides a set of inputs and receives a corresponding output value. This section demonstrates how a complex financial trading strategy, specifically a pairs trading strategy, can be encapsulated into such a black box function, where its performance, measured by the Sharpe ratio, is the output. The black box concept in detail. Imagine a sophisticated machine that takes in a few dials, parameters, and, after some internal calculations, spits out a single number, performance. You don't need to understand the gears, circuits, or algorithms inside. All you care about is that for different dial settings, you get different performance numbers, and you want to find the settings that yield the best performance. In the context of Bayesian optimization, our black box is a Python function or method that 1. Takes specific inputs. These are the hyperparameters of our trading strategy, e.g., entry and exit thresholds. 2. Performs complex calculations internally. This involves fetching data, running statistical models, simulating trades, and calculating performance metrics. 3. Returns a single scalar output, this output representing, essence the goodness of the given inputs, which the optimizer aims to maximize or minimize. The internal complexity of the trading strategy, how it calculates spreads, generates signals, or determines positions, is entirely hidden from the Bayesian optimization algorithm. This abstraction allows us to optimize highly intricate systems without needing an analytical, differentiable form of their objective function, which is often impossible for real-world trading strategies. Pairs trading strategy, a refresher. Before diving into the code, let's briefly recap the core idea behind a pairs trading strategy. Pairs trading is a mean reversion strategy that exploits the relative mispricing between two historically correlated assets, often referred to as co-integrated assets. The fundamental steps are: 1. Select a pair. Identify two assets, e.g., stocks, ETFs, that historically move together. 2. Form the spread. Calculate the difference or ratio between their prices. Often, this involves a linear regression to find a hedge ratio, then forming the spread as one asset's price minus the hedge ratio times the other asset's price. 3. Monitor the spread. The spread is expected to revert to its mean. When the spread deviates significantly from its historical average, e.g., goes above a certain threshold, implying the pair is too wide, a trading signal is generated. 4. Execute trades. If the spread is significantly above its mean, the expensive asset is shorted and the cheap asset is longed. This is a short spread position. If the spread is significantly below its mean, the cheap asset is shorted and the expensive asset is longed. This is a long spread position. 5. Close trades. When the spread reverts to its mean or crosses a narrower exit threshold, the positions are closed. The strategy relies on the statistical property of mean reversion in the spread. A critical statistical test for this property is the augmented Dickey-Fuller (ADF) test, which checks for stationarity. while not explicitly used in the provided code snippet. In a production-grade pairs trading system, one would typically perform an ADF test on the calculated spread to ensure it is stationary before implementing the strategy. A non-stationary spread would imply that the relationship between the assets is breaking down, making mean reversion unreliable. Setting up the environment and core class structure. To implement our black box function, we first need to ensure we have the necessary Python libraries installed and imported. We will encapsulate our strategy within a Python class, code snippet, which will manage data, calculations, and parameter inputs. Download the code on one pagecode substack. This command ensures that all required libraries for data handling, statistical analysis, numerical operations, plotting, and PyTorch-related functionalities, specifically code snippet for class structure, even if not for deep learning computations, are available. The code. The snippet flag separates verbose output. Download the code on one pagecode substack. We import standard libraries like code snippet for data manipulation, code snippet for numerical operations, code snippet for fetching financial data, code snippet for statistical regression, and code snippet for plotting. We also import code snippet and code snippet because our code snippet class will inherit from code snippet. Why code snippet? Inheriting from code snippet makes an instance of code snippet callable like a function, e.g., code snippet. While code snippet is primarily designed for neural networks in PyTorch, it provides a convenient structure for objects that encapsulate parameters and have a code snippet method that defines their computation. For our purposes, it simply allows us to treat our strategy object as a function that takes parameters and returns a performance metric, which aligns well with how code snippet, a Bayesian optimization library built on PyTorch, expects objective functions to behave. It simplifies the interface for the optimizer, even though we are not performing gradient-based optimization or building a neural network. Download the code on one pagecode substack. The code snippet class is initialized with the stock ticker pair, the date range for backtesting, and a risk-free rate. The code snippet method immediately calls code snippet to fetch the required historical data, making it ready for strategy execution. Data acquisition and preparation. Code snippet method handles the crucial first step, obtaining clean, reliable historical price data for our chosen stock pair. Download the code on one pagecode substack. This method uses code snippet to retrieve code snippet prices. It then drops any rows with code snippet values to ensure data integrity. A code snippet is raised if no data or insufficient data is found, preventing downstream errors. The code snippet argument keeps the output clean during data download. The code snippet method, implementing the strategy logic. The code snippet method is the heart of our black box function. It takes the strategy's hyperparameters, entry and exit thresholds, as input, simulates the pair's trading strategy, and returns the calculated Sharpe ratio. This is the method that Bayesian optimization will repeatedly call to evaluate different parameter combinations. Download the code on one pagecode substack. The code snippet method starts by converting the PyTorch tensors for thresholds into standard Python floats, as code snippet and code snippet prefer them. It includes a critical sanity check. If the code snippet is not logically smaller than the code snippet, it immediately returns a heavily penalized, negative Sharpe ratio. This guides the optimizer away from nonsensical parameter combinations. Then, it copies the stock data to prevent unintended modifications. The core of pairs trading is establishing the relationship between the two assets. This is done using ordinary least squares OLS regression, where one stock's price, code snippet, is regressed against the other's, code snippet, to find the hedge ratio, beta, and intercept alpha. The code snippet adds a constant term to the independent variable, allowing the OLS model to fit an intercept. The code snippet is then computed as the difference between the actual price of code snippet and its price predicted by the regression model. This code snippet is the key variable for generating trading signals. Download the code on one pagecode substack. Next, we introduce code snippet for calculating rolling statistics of the spread. This code snippet is fixed here, but could itself be another hyperparameter for Bayesian optimization. The code snippet is calculated by normalizing the spread using its rolling mean and standard deviation. The code snippet is crucial as it quantifies the deviation from the mean, providing a standardized signal for entry and exit. We initialize code snippet and code snippet series to store the simulated trading activity and profits. Code snippet keeps track of the open trade state. Download the code on OnePageCode Substack. This is the core trading logic. The loop iterates through the code snippet time series, starting from the code snippet, after the rolling window has accumulated enough data. The code snippet structure defines the state machine for trading. Flat. No position opens a short spread position if code snippet spread is too wide / y is too expensive relative. E to X, or a long spread position if code snippet spread is too narrow / y is too cheap relative to X. Short spread closes the position if the code snippet reverts towards the mean code snippet. It can also reverse into a long position if the code snippet crosses code snippet on the downside, indicating a strong reversal. Long spread closes the position if the code snippet reverts towards the mean code snippet. It can also reverse into a short position if the code snippet crosses code snippet on the upside. The code snippet line records the determined position for the current day. Download the code on OnePageCode Substack. This section is critical for correctly calculating the strategy's performance. First, code snippet are computed using code snippet. A crucial step to prevent look-ahead bias is code snippet. This ensures that a trading decision made on day code snippet, based on code snippet at day code snippet, only affects the returns starting from day code snippet. Without this shift, we would be using information from the future, i.e., today's code snippet to trade on today's prices, which is unrealistic. The code snippet is calculated by multiplying the code snippet by the spread return, which is code snippet. This effectively simulates the profit/loss from holding the spread position. Code snippet is used to handle periods where no position was held. Finally, code snippet and code snippet are calculated. Download the code on OnePageCode Substack. The final part of the code snippet method calculates the Sharpe ratio. Annualized volatility, calculated by taking the standard deviation of daily returns and multiplying by the square root of 252, approximate number of trading days in a year. Annualized return. The total return is annualized by raising code snippet to the power of code snippet, then subtracting 1. This correctly scales the total return over the backtesting period to an annual equivalent. Sharpe ratio, computed using the standard formula. Code snippet. A robust check for code snippet is included. If volatility is 0, meaning no trades or constant returns, which is highly unlikely for a real strategy, often indicating an issue, a heavily penalized Sharpe ratio, code snippet, is returned. This prevents division by 0 and signals to the optimizer that these parameters are undesirable. Finally, the Sharpe ratio is returned as a code snippet. Note the negative sign. Code snippet by default performs minimization. By returning the negative Sharpe ratio, we effectively transform the maximization problem, find parameters that maximize Sharpe, into a minimization problem, find parameters that minimize negative Sharpe. Rationale for Sharpe ratio as objective function. The Sharpe ratio is a widely used metric in finance to evaluate the risk-adjusted return of an investment or strategy. It measures the excess return above the risk-free rate per unit of total risk standard deviation. Strengths. It's intuitive, widely understood, and considers both return and volatility, making it suitable for comparing strategies. Weaknesses. It assumes returns are normally distributed and penalizes both upside and downside volatility equally. It might not be ideal for strategies with highly skewed returns or those focused on downside risk protection. Other potential performance metrics. Sortino ratio, similar to Sharpe but only penalizes downside volatility, making it more suitable for strategies where upside volatility is desirable. Kalmar ratio measures the average annual return relative to the maximum drawdown, focusing on capital preservation. Maximum drawdown, the largest peak-to-trough decline in the equity curve, indicating worst-case risk. Profit factor, total gross profits divided by total gross losses, indicating the profitability per unit of loss. Compound annual growth rate, CAGR, the annualized rate of return, ignoring risk. The choice of objective function depends on the specific goals of the optimization. For a general-purpose strategy like pairs trading, maximizing the risk-adjusted return, Sharpe ratio, is a common and reasonable objective. However, for strategies focused on specific risk profiles, e.g., low drawdown, other metrics might be more appropriate. Testing the black box function. Before integrating our code snippet with the full Bayesian optimization loop, it's crucial to test its functionality independently. This ensures that the black box function behaves as expected and produces sensible outputs for different input parameters. Download the code on one patchcode Substack. This test snippet demonstrates how to instantiate code snippet and call its code snippet method with different code snippet inputs for code snippet and code snippet. Observe how the Sharpe ratio changes with different parameters and confirm that a logical parameter combinations, e.g., code snippet, result in a heavily penalized, very negative, Sharpe ratio as designed. Visualizing strategy mechanics. To gain a deeper understanding of how the pairs trading strategy functions, it's beneficial to visualize the calculated spread, its z-score, the defined thresholds, and the resulting trading signals. This helps in understanding the impact of parameter choices. Download the code on one patchcode Substack. This code snippet function, which would ideally be a method within code snippet to access internal states, helps visualize the code snippet movement relative to the code snippet and code snippet. The bottom subplot shows the resulting code snippet for short spread, code snippet for flat, code snippet for long spread, demonstrating how the strategy enters and exits trades based on the z-score crossing the defined boundaries. This visual feedback is invaluable for understanding the strategy's behavior and the impact of the optimized parameters. Integrating with Bayesian optimization, conceptual. While the full Bayesian optimization loop will be co-varied in subsequent sections, it's important to understand how this code snippet class fits into the larger framework. The code snippet method is precisely what code snippet will call repeatedly. Download the code on one patchcode Substack. This conceptual snippet illustrates that the code snippet instance, with its code snippet method, is the direct interface for the Bayesian optimization algorithm. The code snippet defines the search space for the code snippet and code snippet. The optimizer will then intelligently choose different combinations of these parameters, feed them into code snippet, and use the return Sharpe ratio to guide its search for the optimal strategy. Adaptability and customization. The code snippet class provides a robust foundation that can be extended or adapted for various other quantitative trading strategies or optimization problems. Different trading strategies. The core logic within the code snippet method can be entirely replaced to implement other strategies, e.g., momentum, mean reversion using Bollinger Bands, trend following with moving averages, or even more complex machine learning-based strategies. The key is that the method still takes hyperparameters as input and returns a single performance metric as output. More parameters. Additional strategy parameters, e.g., the code snippet for rolling calculations, look-back periods, leverage, stop-loss/take profit levels, can be added as inputs to the code snippet method, expanding the search space for Bayesian optimization. Multiple objective functions. While this example optimizes for a single metric, Sharpe ratio, the code snippet method could be modified to return a vector of metrics, e.g., code snippet. This would then require a multi-objective Bayesian optimization approach, which is more complex but allows for optimizing trade-offs between different performance aspects. Alternative asset classes. The code snippet data acquisition can be swapped out for other data sources to backtest strategies on different asset classes like cryptocurrencies, forex, or commodities. Custom backtest reports. As mentioned in the professor's analysis, the code snippet could include a method to generate a more detailed backtest report, including an equity curve plot, maximum drawdown, and other statistics, which would be useful for post-optimization analysis. Generating training set for Bayesian optimization. Bayesian optimization, BO, is an iterative process. Unlike grid search or random search, which explore the entire search space, BO intelligently selects new points to evaluate based on a probabilistic model of the objective function. This model, typically a Gaussian process, GP, needs initial data to learn from. This section details how to generate this crucial initial training set, which forms the foundation for the GP surrogate model. The purpose of initial samples. The initial training set is the bedrock upon which the Gaussian process builds its understanding of the objective function. Think of it as the initial training data for our probabilistic model. Without any data points, the GP cannot infer the relationship between input parameters and their corresponding objective values, e.g., Sharpe ratios. Each data point in this initial set consists of 1. Input parameters, code snippet, a specific combination of the parameters we want to optimize, e.g., code snippet and code snippet. 2. Objective value, code snippet, the performance metric, e.g., Sharpe ratio, obtained by evaluating the black box function with those input parameters. The Gaussian process will then use these code snippet pairs to construct its mean and covariance functions, providing both a prediction of the objective value at unobserved points and a measure of uncertainty around that prediction. An important byproduct of generating this initial set is identifying the code snippet. This value represents the highest or lowest, depending on optimization goal, objective value found so far. It serves as a crucial benchmark for acquisition functions like expected improvement, EI, which aim to find new points that are likely to surpass this current best. Defining the search space and parameters. For this practical application of Bayesian optimization, we focus on optimizing a pair's trading strategy. The strategy's performance is highly dependent on two key parameters. Code snippet, the z-score threshold at which we enter a trade, e.g., if the spread z-score exceeds this value. Code snippet, the z-score threshold at which we exit a trade, e.g., if the spread z-score reverts to within this value. It's critical to note that while previous theoretical discussions might have referenced window lengths for a trend-following strategy, this specific implementation optimizes code snippet and code snippet for a pair's trading strategy. This distinction is important for understanding the context and the chosen parameter bounds. The bounds for these parameters are defined as follows. Code snippet, between code snippet and code snippet. Code snippet, between code snippet and code snippet. These bounds are chosen to represent realistic and effective ranges for z-score thresholds in a pair's trading context. For instance, an entry threshold too close to 0 might lead to excessive false signals, while one too high might ISS opportunities. Similarly, an exit threshold near 0 implies holding until the spread mean reverts entirely, while a higher value might trigger premature exits. Setting up the environment. Before generating data, we need to set up the computational environment, specifying the device, CPU or GPU, and the default data type for PyTorch tensors. This ensures consistency and leverages hardware acceleration if available. We also set a random seed for reproducibility. Download the code on one patchcode substack. This initial setup establishes the environment. The code snippet class is a placeholder for your actual strategy backtesting function. It's crucial that this function takes the parameters as code snippet objects and returns a code snippet representing the objective value, e.g., Sharpe ratio. Implementing initial data generation. The core of this section is the code snippet function, which programmatically creates the starting dataset. Function definition and parameter generation. We define the function code snippet, which takes code snippet as an argument, representing the number of initial samples to generate. Inside this function, we generate code snippet random values for both code snippet, and code snippet. Crucial correction for code snippet usage. The original code snippet for code snippet generation, code snippet, would produce values only between 0 and 1. To correctly scale random numbers to any arbitrary range code snippet, the F formula code snippet must be used. We apply this correction below to ensure code snippet values are correctly sampled within code snippet. Download the code on one patchcode substack. This initial part of the function sets up the generation of our two-dimensional input parameters. The use of code snippet ensures uniform sampling across the specified bounds, providing a broad initial exploration of a search space, combining inputs and evaluating the black box. Once individual parameter tensors are generated, they are concatenated to form a single code snippet tensor of shape code snippet, where each row represents a unique combination of code snippet. We then iterate through each of these code snippet combinations, evaluate our code snippet, the black box objective function, and collect the resulting Sharpe ratios. Download the code on one pagecode Substack. The loop is a direct evaluation of our strategy for each randomly sampled parameter pair. The code snippet method simulates running a backtest for that specific strategy configuration and returning its Sharpe ratio. Tensor conversion and best value identification. After collecting all objective values in a Python list, we convert it into a PyTorch tensor, code snippet. The code snippet operation is vital here. Code snippet explanation. PyTorch often expects tensors to have an explicit dimension for batches or features. When we convert a 1D list of code snippet scalar Sharpe ratios into a tensor, it results in a shape of code snippet. However, for subsequent Bayesian optimization steps, especially when interacting with Gaussian processes and acquisition functions, objective values are typically expected to have a shape of code snippet or code snippet if the objective is multidimensional. Code snippet adds a new dimension of size 1 at the end, transforming code snippet into code snippet, which aligns with the expected input format for many BO libraries and models. Finally, we identify the code snippet by taking the maximum from code snippet. Download the code on one pagecode Substack. This comprehensive function provides the initial data necessary for the Gaussian process to begin modeling the objective landscape. The output code snippet and code snippet are in the correct tensor format for direct use in subsequent BO steps. Considerations for initial sampling. The method chosen for initial sampling can significantly impact the efficiency and effectiveness of the subsequent Bayesian optimization process. Impact of initial sample size, code snippet. The number of initial samples code snippet dictates how much information the Gaussian process has about the objective function from the outset. Small code snippet. The GP will have very little information, leading to high uncertainty across most of the search space. This might cause the acquisition function to explore broadly in early iterations. It's computationally cheaper, but might take more iterations to converge. Large code snippet. The GP will have a more informed initial model, potentially guiding the acquisition function to promising regions faster. However, it's computationally expensive to generate a large initial set, as each sample requires an evaluation of the black box function, e.g., a full backtest. The benefit of more information must outweigh the cost of initial evaluations. The choice of code snippet often depends on the computational budget for black box evaluations and any prior knowledge about the objective function's complexity. Random sampling versus Latin hypercube sampling, LHS. Random sampling, used here, simple to implement. Points are chosen independently and uniformly at random within the bounds. While effective, there's no guarantee of uniform coverage of the search space. Random clustering of points can occur. Latin hypercube sampling, LHS, a space-filling sampling technique. It ensures that each dimension of the input space is sampled exactly once within each of code snippet strata. This provides a more uniform distribution of points across the search space compared to pure random sampling, which can be beneficial for building a better initial GP model. For more complex, multidimensional problems, LHS is often preferred for initial sampling. Constraint handling. In real-world financial strategies, parameters often have logical dependencies. For instance, in some pairs trading strategies, the code snippet might logically need to be greater than the code snippet, e.g., y. You enter at a spread of 2.0 and exit when it reverts to 0.5, not 2.5. The current random sampling might generate invalid combinations where code snippet. To make the example more robust, we can add a check or resampling logic within the loop. Download the code on one Code Substack. This constrained generation logic demonstrates how to handle practical requirements that arise from the nature of the parameters being optimized. Visualizing the initial training set. Visualizing the initial training points can provide valuable insights into how the search space is covered and where the initial good points are located. For a 2D input space, like our code snippet and code snippet, a scatter plot is ideal. We can color code the points based on their corresponding Sharpe ratio to immediately see performance variations. Download the code on one Code Substack. This plot visually confirms the distribution of initial samples and highlights which areas of the parameter space yield higher or lower Sharpe ratios, giving an intuitive sense of the objective functions landscape. Best practices and real-world applications. Generating the initial training set is a common pattern not only in Bayesian optimization, but also in many other machine learning and optimization workflows, such as hyperparameter tuning, initial random search before more sophisticated methods, Monte Carlo simulations, drawing initial samples from a distribution, experiment design, deciding initial CONF, iterations for physical or digital experiments. Reproducibility, always setting a random seed, as demonstrated, is crucial for reproducibility. This ensures that if you or someone else runs the code again, the exact same initial samples will be generated, leading to consistent results. In larger projects, managing seeds across different modules or processes is a key best practice. Choosing code snippet in practice. The decision on the number of initial samples, code snippet, in a real-world scenario often boils down to a trade-off. Computational budget. How many black box evaluations can you afford? If each evaluation, e.g., a backtest, takes hours, code snippet will be small. Prior knowledge. Do you have any intuition about the objective function? If it's expected to be highly multimodal or complex, a larger code snippet might be warranted to capture more of its structure initially. Dimensionality. For higher dimensional input spaces, a larger code snippet is generally needed to adequately explore the space. Although even then, initial random sampling might struggle, making LHS or other space-filling designs more appealing. This initial data generation step, while seemingly simple, is foundational for the success of Bayesian optimization, providing the necessary empirical data for the probabilistic model to begin its intelligent search. Implementing the Gaussian process model. Gaussian process, GP, models serve as the probabilistic surrogate models in Bayesian optimization. They are powerful non-parametric models that can approximate complex, unknown objective functions, such as the performance of a trading strategy under different parameter settings. Crucially, GPs not only provide a prediction of the function's value, but also quantify the uncertainty around that prediction, which is vital for making informed decisions in the optimization process. The role of Gaussian process hyperparameters. While GPs are often described as non-parametric, their behavior and flexibility are governed by a set of hyperparameters. These hyperparameters define the properties of the underlying function that the GP is trying to model, such as its smoothness, amplitude, and the level of observation noise. Optimizing these hyperparameters is critical. It allows the GP model to adapt its assumptions to the observed training data, leading to more accurate predictions and more reliable uncertainty estimates. In the context of quantitative finance, a well-calibrated GP model means better estimates of strategies' expected return and, more importantly, its risk uncertainty. A miscalibrated GP might lead to exploring suboptimal regions or misjudging the robustness of a potential trading strategy. The primary components governing a GP's behavior are its mean function and its covariance function, or kernel. Mean function defines the prior mean of the GP. A code snippet function, common in code snippet by default, assumes the function's average value is constant across the input space. Covariance function. Kernel determines the covariance between any 2 points in the input space, effectively defining the smoothness, periodicity, or other structural properties of the function. The choice of kernel is crucial as it encodes our assumptions about the function's behavior. Noise. represents the observation noise in the training data. This accounts for deviations between the true underlying function and the observed data points. Let's set up our environment and generate some simple synthetic data to illustrate the concepts. This will allow us to visually inspect the GP's behavior before and after hyperparameter optimization. Download the code on one patch code Substack. This initial code block sets up our computing environment by importing the required libraries and defining the code snippet and code snippet for PyTorch tensors. Using code snippet double precision is a best practice for GP models due to their sensitivity to numerical precision. Generating synthetic training data. To clearly demonstrate the impact of hyperparameter optimization, we will use a simple one-dimensional synthetic objective function. This allows us to easily visualize the GP's predictions and uncertainty. Download the code on one patch code Substack. Here, we define code snippet, a simple function that will act as our black B. Aux function for demonstration. We then generate code snippet, input points, and code snippet corresponding noisy observations, which will serve as a training set for our GP model. The code snippet operation is important as code snippet expects input tensors to have an explicit feature dimension, e.g., code snippet. Initializing the Gaussian process model. Code snippet provides code snippet as a convenient wrapper for defining a Gaussian process model when dealing with a single objective function. It internally uses code snippet for the core GP computations. Download the code on one patch code Substack. The code snippet function encapsulates the creation of the code snippet model and the code snippet MLL object. Code snippet. This instantiates our GP. By default, code snippet assumes a code snippet for its covariance function and a code snippet function. The Mattern 5.2 kernel is a popular choice for its balance between smoothness and expressiveness. It implies that the underlying function is twice differentiable, making it smoother than, say, an exponential kernel, but less smooth than a squared exponential, RBF kernel. The constant mean function assumes the average value of the function is a single constant. Code snippet. This object is crucial for hyperparameter optimization. The MLL is the objective function we will maximize to find the best-fitting hyperparameters for our GP. It represents how well the model explains the observed data. Inspecting initial hyperparameters. Before optimization, the GP model's hyperparameters are initialized to default values. It's useful to inspect these to understand their starting point. Download the code on one patch code Substack. The code snippet method allows us to access the internal parameters of the GP model. These are PyTorch code snippet objects with code snippet, meaning they are part of the computational graph and their values will be adjusted during the optimization process. The code snippet prefix indicates that these are untransformed values. The actual noise, output scale, and length scale are derived from these raw values via transformations, e.g., soft plus, to ensure they remain positive. At this stage, the GP's assumptions about the underlying function, smoothness, noise, amplitude, are generic based on these default values. Without optimization, the model might not accurately represent the true function or its uncertainties. Understanding maximum log likelihood, MLL, optimization. The core principle behind optimizing GP hyperparameters is maximum log likelihood, MLL. Given a set of observed data points, the MLL approach aims to find a set of hyperparameters that maximize the probability of observing that data. In other words, it seeks the hyperparameters that make the observed data most likely under the GP model. Why maximize the log likelihood? 1. Numerical stability. Likelihood values can become very small, leading to underflow issues. Taking the logarithm converts products into sums, which are numerically more stable. 2. Computational convenience. Optimization algorithms often work better with sums than products. 3. Monotonicity. The logarithm is a monotonically increasing function, so maximizing the log likelihood is equivalent to maximizing the likelihood itself. By maximizing the MLL, the GP model adapts its mean and covariance functions to best fit the training data. This process effectively fine-tunes the model's assumptions about the underlying function's characteristics, e.g., how smooth it is, how much noise is present, to the observed reality. This leads to a more accurate surrogate model for the Bayesian optimization loop. Optimizing GP hyperparameters with code snippet. Code snippet provides the code snippet utility function to perform the MLL optimization. This function internally uses PyTorch's optimizers like Atom to iteratively adjust the hyperparameters until the marginal log likelihood is maximized. Download the code on OnePageCode Substack. In this step, we call code snippet to perform the optimization. Code snippet. It's a common practice and often recommended by code snippet documentation to move the code snippet object to the CPU for the optimization step. While GPUs accelerate many deep learning tasks, the specific optimization routine for GP hyperparameters in code snippet can sometimes be more stable or even faster on the CPU for smaller models. After optimization, we move it back to the code snippet for consist. And see why. Code snippet and code snippet. These calls set the model and likelihood to training mode, enabling features like gradient tracking for optimization. Code snippet and code snippet. After optimization, we switch to evaluation mode. This disables features like dropout, though not relevant for GPs, and ensures consistent behavior for predictions. Inspecting optimized hyperparameters. After optimization, we can inspect the hyperparameters again to see how they have changed. These new values reflect the GP's learned assumptions about the training data. Download the code on OnePageCode Substack. The optimized code snippet will ideally decrease if the training data is relatively clean. The code snippet will adjust to reflect the vertical spread of the observed code snippet values. Most importantly, the code snippet will adapt to the observed smoothness or roughness of the function. For instance, if data points close to each other have very different code snippet values, the length scale will decrease, indicating a rapidly changing function. Conversely, if nearby points have similar code snippet values, the length scale will increase, suggesting a smoother function. Visualizing the impact of hyperparameter optimization. To truly grasp the significance of hyperparameter optimization, let's visualize the GP's predictions and uncertainty bands before and after this process. Download the code on OnePageCode Substack. This visualization is key. Before optimization, the GP mean prediction might be relatively flat or follow a generic trend. Its uncertainty bands might be uniformly wide. This is because the hyperparameters, length scale, output scale, noise, are at their default values and do not yet reflect the actual characteristics of our code snippet function. The GP is essentially making prior predictions based on its default assumptions. After optimization, the GP's mean prediction will now closely follow the code snippet points, effectively capturing the underlying trend of the code snippet function. The uncertainty bands will shrink significantly around the observed training data points, indicating high confidence where data is available. Crucially, the uncertainty will expand in regions where there is no data, reflecting the GP's increased doubt in those areas. This demonstrates how the optimized hyperparameters allow the GP to provide a much more accurate and informative surrogate model. Advanced considerations. While the Mattern 5-halves kernel with a constant mean is a strong default, code snippet and code snippet offer a rich selection of other kernels and mean functions. Kernels. RBF, squared exponential. Kernel assumes infinitely differentiable functions, leading to very smooth predictions. Might be too smooth for some real-world financial data. Polynomial kernel, useful for modeling polynomial trends. Periodic kernel, for functions with repeating patterns, e.g., seasonality in financial time series. Linear kernel, for funct, ions with linear trends. You can also combine kernels, e.g., sum or product, to create more complex covariance functions. Mean functions. Besides code snippet, you can use code snippet, assumes mean is 0, code snippet, or even define custom mean functions. Choosing the right kernel and mean function is a form of model selection. It encodes your prior beliefs about the function structure. For most black box optimization tasks where little is known about the objective, the Mattern 5 halves kernel is a robust and flexible choice. Common pitfalls. Local optima. MLL optimization is a nonconvex problem, meaning code snippet can get stuck in a local optimum. For critical applications, running the optimization multiple times from different random initializations can help. Computational cost. GP training scales cubically with the number of training points, code snippet, which can become computationally expensive for very large datasets. For Bayesian optimization, code snippet typically remains relatively small, hundreds to a few thousands, making it feasible. By understanding the role of hyperparameters, the principle of MLL optimization, and how to implement it, you gain a powerful tool for building effective surrogate models in Bayesian optimization, capable of accurately guiding the search for optimal trading strategies. Guiding the sequential search by maximizing the acquisition function. After establishing our Gaussian process, GP, model, the next crucial step in Bayesian optimization is to decide where to sample next in the search space. This decision is guided by an acquisition function, which quantifies the utility of sampling at any given point. The acquisition function leverages the GP's predictions, mean, and uncertainty to balance exploration, sampling in regions of high uncertainty to reduce model error, and exploitation, sampling in regions predicted to have high objective values. The role of acquisition functions. An acquisition function transforms the GP's posterior distribution, mean and variance at unobserved points, into a score that indicates the potential value of evaluating the objective function at a particular input. The goal is to maximize this acquisition function to identify the most promising next candidate points. The core challenge in sequential optimization, especially for expensive to evaluate functions like our trading strategy, is the exploration-exploitation trade-off. Exploitation, sampling points where the GP model predicts a high objective value, mean. This aims to improve the current best observed result directly. Exploration, sampling points where the GP model has high uncertainty, variance. This helps to refine the GP model in less known regions, potentially uncovering new, better optima, or reducing the risk of missing them. Acquisition function. Provide a principled way to navigate this trade-off. Different acquisition functions implement this balance in various ways, making them suitable for different optimization scenarios. Common acquisition functions in botorch. Botorch provides a rich set of pre-implemented acquisition functions. We will explore some of the most widely used ones and their practical instantiation. Each acquisition function requires the code snippet, our trained Gaussian process, and potentially other parameters to guide its behavior. Expected improvement, EI. Expected improvement, EI, is one of the most popular acquisition functions. It quantifies the expected improvement over the current best observed objective value, considering the uncertainty modeled by the GP. EI is particularly good at exploiting known good regions, while still allowing for some exploration in uncertain areas that might lead to significant improvements. The code snippet parameter is critical for EI. It represents the best objective value observed so far. EI will then prioritize points that are likely to surpass this code snippet. Download the code on one patchcode Substack. This snippet initializes the code snippet acquisition function. It takes our code snippet and the code snippet, the highest profit found by our trading strategy so far, as inputs. The function will then compute a score for each potential input configuration, indicating how much improvement we can expect at that point. Upper confidence bound, UCB. The upper confidence bound, UCB, acquisition function directly combines the GP's mean prediction and its uncertainty, standard deviation, to form an optimistic estimate of the objective value. It is defined as UCB x równa się mu x plus beta sigma x, where $mu x dollar is the mean prediction of the GP at $x. $sigma x dollar is the standard deviation prediction of the GP at $x. $\beta$ is a non-negative tuning parameter that controls the exploration-exploitation trade-off. A higher value of $\beta$ places more weight on the uncertainty $\sigma x$, encouraging more exploration in less-known regions. Conversely, a lower $\beta$ focuses more on the mean prediction $mu x$, leading to more exploitation of regions predicted to have high values. Choosing an appropriate $beta$ value is crucial and often depends on the problem's characteristics and the desired balance. Download the code on OnePatchCode Substack. Here, we instantiate code snippet, passing our code snippet and the chosen code snippet. This function will then prioritize points that are either predicted to be very good or highly uncertain, with the balance controlled by code snippet. Q expected improvement, QEI. Many real-world optimization problems, especially in quant trading, benefit from evaluating multiple candidate points in parallel. For instance, if you have access to a cluster of machines, you might want to run several simulations of your trading strategy simultaneously. Single-point acquis. Bayesian functions like EI and UCB are designed for sequential evaluation, one point at a time. Q expected improvement, QEI, extends the concept of EI to handle batches of code snippet candidate points. Instead of finding the single best point, QEI aims to find a batch of code snippet points that, when evaluated together, are expected to yield the highest collective improvement. This is a more complex calculation as it needs to account for the dependencies between the points in the batch, how evaluating one point changes the uncertainty for others in the same batch. Download the code on OnePatchCode Substack. The code snippet class is instantiated similarly to code snippet. The Q aspect is primarily handled during the optimization phase, where code snippet will be instructed to find code snippet points simultaneously. Q-knowledge gradient, QKG. Q-knowledge gradient, QKG, is a sophisticated batch acquisition function that aims to maximize the expected future improvement, assuming that after evaluating the current batch of code snippet points, we would then make optimal subsequent decisions. Unlike QEI, which looks at the immediate expected improvement of the batch, QKG considers the long-term impact of adding new data points. It tries to identify points that are not just good themselves, but also provide the most information gain that will lead to better decisions in future iterations. This forward-looking nature makes QKG computationally more intensive, often REQ. Using Monte Carlo simulations, controlled by code snippet, to estimate the expected future improvement. Code snippet dictates how many hypothetical future GP models are simulated to average out the expected future gains. A higher code snippet leads to a more accurate, but more computationally expensive, estimate. Code snippet represents the current set of observed data points. Download the code on OnePatchCode Substack. The code snippet function is instantiated with the code snippet, and code snippet. It's generally preferred for problems where information gain is highly valued, and the computational cost is acceptable. Maximizing the acquisition function to find the next point. Once an acquisition function is instantiated, the next step is to find the input parameter configuration, or batch of configurations, that maximizes its value. This is itself an optimization problem, typically solved using gradient-based optimization methods with multiple restarts to avoid local optima. Botorch provides the code snippet utility for this purpose. The code snippet function takes the acquisition function, the bounds of the search space, and parameters controlling the optimization process. Code snippet. This parameter specifies the number of candidate points to find in a batch. 4 single-point acquisition functions, like code snippet or code snippet. Code snippet would typically be code snippet. 4 batch acquisition functions, like code snippet or code snippet, COD. eSnippet would be set to your desired batch size, e.g., code snippet. Code snippet. The number of times the local optimizer is restarted from different initial points. A higher number increases the chance of finding the global maximum of the acquisition function, but also increases computation time. Code snippet. The number of random samples drawn from the search space to generate the initial points for the multi-start optimization. These samples are then refined by the local optimizer. A higher number of raw samples provides a better chance of finding good starting points. Download the code on one patch code Substack. These constants define the robustness of the inner optimization process for the acquisition function. More restarts and raw samples lead to a more thorough search for the acquisition function's maximum, which in turn leads to better proposed candidate points. Download the code on one patch code Substack. This function encapsulates the critical step of finding the next candidate points. It takes the chosen code snippet, the code snippet of our search space, and our code snippet, which simulates our trading strategy and returns its profit. The code snippet call is the heart of this function, performing the maximization. The code snippet operation is vital. It prevents PyTorch from trying to compute gradients through our code snippet, which is treated as a black box in Bayesian optimization. Baseline, random search. To truly appreciate the efficiency of Bayes. In optimization, it's essential to compare its performance against a simpler, less intelligent baseline. A common and straightforward baseline is random search. In random search, candidate points are chosen uniformly at random from the search space in each iteration, without using any model of the objective function. While simple, random search can be surprisingly effective for high-dimensional problems, but often requires many more evaluations to find good solutions compared to model-based methods like Bayesian optimization. The code snippet function simulates one iteration of a random search. Download the code on one patch code Substack. This function demonstrates how a random search point is generated and evaluated. It directly samples from a uniform distribution defined by our code snippet and then calls our code snippet to get the performance of the trading strategy at these random parameters. Integrating into the Bayesian optimization loop. The functions and concepts discussed so far are the building blocks for an iterative Bayesian optimization loop. Each iteration of a loop follows these general steps. 1. Fit the Gaussian process model. The GP model is trained or updated using all available data. Code snippet, code snippet. 2. Choose an update acquisition function. An acquisition function is selected, e.g., EI, UCB, QEI, and updated with the latest code snippet and code snippet, if applicable. 3. Maximize acquisition function. The code snippet function is cal. Let define the most promising code snippet or batch of code snippet values by maximizing the acquisition function. 4. Evaluate objective function. The code snippet is evaluated at code snippet to obtain code snippet. 5. Update training data. The code snippet and code snippet are added to the code snippet and code snippet datasets. 6. Repeat. The loop continues for a specified number of iterations or until a convergence criterion is met. Download the code on one patch code Substack. This conceptual loop illustrates how the pieces fit together. In a complete Bayesian optimization experiment, this process would be repeated for a predefined number of iterations, allowing the GP model to progressively refine its understanding of the objective function and guide the search more effectively. Tracking the code snippet over iterations for both Bayesian optimization and the random search baseline provides a clear visual comparison of their performance and efficiency. Furthermore, visualizing the acquisition function itself, e.g., for a 1D or 2D slice of the search space, can offer intuitive insights into how it balances exploration and exploitation and how its shape evolves with new observations. Computational considerations and trade-offs. The choice of acquisition function and the parameters for its optimization have significant computational implications. Single-point versus batch acquisition functions. Single-point acquisition functions, EI, UCB, are generally faster to optimize, as they search for only one point. Batch acquisition functions, QEI, QKG, are more complex because they must consider the joint expected improvement of multiple points. While they allow for parallel evaluations of the objective function, the optimization of the acquisition function itself is more computationally demanding. Q-knowledge gradient, QKG is typically the most computationally expensive acquisition function due to its reliance on Monte Carlo simulations, code snippet, to estimate future improvements. While powerful for information gain, Its use should be weighed against the available computational resources and the cost of objective function evaluations. Code snippet and code snippet. These parameters for code snippet directly control the thoroughness of the inner optimization. Higher values increase the chance of finding the true maximum of the acquisition function, leading to better proposed points, but the cost of increased computation time for each iteration. Finding a balance is key to efficient optimization. Understanding these trade-offs is crucial for designing an effective and practical Bayesian optimization strategy for your specific problem, whether it's optimizing a quantitative trading strategy or any other expensive black box function. The core of Bayesian optimization lies in its iterative, sequential nature. Unlike grid search or random search, which explore the search space blindly or predefine all points, Bayesian optimization intelligently selects subsequent points based on the information gathered from previous evaluations. This section details the practical implementation of this sequential search process, comparing various acquisition functions against a simple random search baseline. The iterative Bayesian optimization loop. At its heart, Bayesian optimization is a loop that repeats for a predetermined number of iterations or until a stopping criterion is met. Each iteration involves a sequence of critical steps. 1. Model fitting. Update the Gaussian process, GP, model with all observed data points. This refines the model's understanding of the objective function's landscape. 2. Acquisition function maximization. Based on the updated GP model, an acquisition function is maximized to propose the next best point or batch of points to evaluate. This point is chosen to balance exploration, sampling uncertain regions, and exploitation, sampling regions likely to contain the optimum. 3. Objective function evaluation. The proposed points are evaluated using the actual, expensive black box objective function, e.g., running a trading strategy backtest. 4. Data update. The new observations, input parameters, and corresponding objective value are added to the training dataset. This loop continues, with the GP model becoming progressively more accurate and the acquisition function guiding the search more effectively towards the global optimum. Setting up the optimization environment. Before entering the main loop, we need to import necessary libraries, define global parameters, and set up the initial conditions. Download the code on OnePageCode Substack. The initial setup involves importing code snippet for tensor operations, code snippet for numerical utilities, code snippet for plotting, and code snippet for data presentation. Crucially, we import specific components from code snippet for our Gaussian process model, code snippet for the model's objective function during training, and various acquisition functions like code snippet EI, code snippet UCB, code snippet QEI, and code snippet QKG. We also include placeholder definitions for code snippet, and code snippet. In a complete book, these will be defined in preceding sections, e.g., code snippet in the black box objective function section and the helper functions in implementing the Gaussian process model, or guiding the sequential search sections. For this section, we provide a simplified code snippet that simulates a trading strategy evaluation with some added noise, allowing for runnable code examples. Defining optimization parameters. Global parameters control the simulation scale and behavior. Download the code on OnePageCode Substack. Here, the snippet represents the dimensionality of our search space, e.g., 2 parameters for a trading strategy, and code snippet defines the valid range for these parameters. Code snippet specifies the size of our initial training dataset, which is generated randomly. Code snippet is the number of sequential optimization steps. Code snippet allows us to run the entire optimization process multiple times to account for randomness and assess the stability of the results. The code snippet parameter is particularly important for code snippet acquisition functions. While set to code snippet in this example for simplicity, meaning 1 point is proposed per iteration, setting code snippet enables parallel evaluation of multiple candidate points, which can significantly speed up optimization if objective function evaluations can be run concurrently. Code snippet and code snippet are specifically designed to handle this parallel batching more effectively than their single-point counterparts. Running a single optimization trial. Let's first walk through a single trial to understand the iterative process clearly. Download the code on one PageCode Substack. We begin by generating an initial set of code snippet random points and evaluating our code snippet at these points. This forms our starting training dataset, code snippet, code snippet. We then clone this initial data for each of the optimization strategies, EI, QEI, UCB, QKG, and random search to ensure a fair comparison. Lists are initialized to track the cumulative maximum Sharpe ratio observed by each strategy over the iterations. It's important to note the code snippet variables. In some advanced code snippet patterns, a single GP model might be updated and passed around. However, in this common setup, we will refit a new GP model for each strategy in every iteration to ensure it's precisely tailored to the current data accumulated by that specific strategy. The main optimization loop. This loop encapsulates the core sequential search process. Download the code on one PageCode Substack. For each iteration, the sequence of operations for each Bayesian optimization strategy is 1. Model initialization and fitting. A code snippet model is initialized with the current training data, code snippet, code snippet. The code snippet function then optimizes the GP's hyperparameters, e.g., code snippet, code snippet, code snippet, by maximizing the marginal log likelihood. These hyperparameters define the smoothness, amplitude, and noise level of the underlying function that the GP is trying to model. A well-fitted GP provides a more accurate probabilistic representation of the objective function. Rationale for reinitializing GP models. While code snippet allows updating an existing model, reinitializing and refitting the GP model in each iteration, as shown here, is a common practice, especially when the training data changes significantly. It ensures that the model's hyperparameters are re-optimized for the entire accumulated dataset, providing the best possible fit and thus the most reliable predictions for the acquisition function. If not reinitialized, one would typically call code snippet and then code snippet to update the data and refit. Both approaches are valid, but full reinitialization is often simpler for pedagogical purposes and guarantees a fresh hyperparameter optimization. 2. Acquisition function instantiation. An instance of the chosen acquisition function, e.g., code snippet, is created. Expected improvement. EI, this function selects points that are expected to yield the largest improvement over the current best observed value. It's a greedy approach that balances exploration, sampling uncertain regions, and exploitation, sampling regions likely to contain the optimum. Q expected improvement. QEI, this is the Monte Carlo version of EI, designed for optimizing a batch of code snippet candidate points simultaneously. Even when code snippet, it uses Monte Carlo estimation, which would be more robust for complex models or non-standard objectives compared to the analytical EI. For code snippet considers the joint improvement from evaluating multiple points, preventing redundancy within the batch and ensuring the proposed batch is collectively optimal. Upper confidence bound. UCB selects points that maximize a weighted sum of the predicted mean and standard deviation of the GP. The code snippet parameter controls the exploitation trade-off. A higher code snippet places more emphasis on uncertainty exploration, leading to sampling in less explored regions. Conversely, a lower code snippet prioritizes regions with high predicted mean exploitation. We demonstrate a simple dynamic code snippet for illustrative purposes. QKnowledge gradient, QKG, this acquisition function is more sophisticated, aiming to maximize the expected future improvement in the optimum value, rather than just the immediate improvement. It considers how evaluating a new point will reduce uncertainty and potentially shift the estimated optimum. The code snippet parameter for code snippet is used when the code snippet directly predicts the objective value, as is the case with code snippet. If you had a multi-output GP and wanted to optimize a specific output, you would define a code snippet function to select or combine those outputs. Like code snippet is designed for batch optimization. 3. Candidate generation. The code snippet helper function maximizes the instantiated acquisition function over the defined code snippet to find the next code snippet most promising points, code snippet. These points are then evaluated using our code snippet to get their corresponding Sharpe ratios, code snippet. Noise and objective function. Our code snippet includes a small, controlled noise component. This simulates real-world scenarios where objective function evaluations, e.g., backtest results, might not be perfectly deterministic due to factors like market microstructure, random order execution, or even numerical precision. Bayesian optimization is robust to such noise. 4. Data update. The newly observed code snippet and code snippet are concatenated with the existing code snippet and code snippet tensors, expanding the dataset for the next iteration. The maximum observed Sharpe ratio is updated and recorded. 5. Random search baseline. In parallel, a random search baseline generates code snippet new random points and evaluates them, updating its own best observed value. This provides a crucial comparison point to demonstrate the efficiency gains of model-based Bayesian optimization. Visualizing single trial results. After the single trial, plotting the cumulative best observed Sharpe ratio for each strategy provides immediate insight into their performance. Download the code on OnePageCode Substack. The plot visually demonstrates how each strategy progresses in finding higher Sharpe ratios. Typically, Bayesian optimization methods, EI, QEI, UCB, QKG, will show a steeper increase in the cumulative best value early on and converge faster to a high-performing region compared to random search, which explores the space less efficiently. Running multiple trials for robustness. A single trial can be influenced by the initial random points or the inherent stochasticity of the objective function. To obtain more statistically robust results, it's standard practice to repeat the entire optimization process multiple times. Download the code on OnePageCode Substack. The multiple trial loop repeats the entire single trial process. A critical consideration for multiple trials is how to handle randomness. If the goal is to assess the average performance across truly independent runs, it's best to explicitly set a different random seed for each trial using code snippet and code snippet. This ensures that the initial random points and any internal stochasticity, like the noise in our code snippet, are different for each trial, providing a more robust statistical assessment. Analyzing multi-trial results. Finally, we compute the mean and standard deviation of the final best Sharpe ratios across all trials to summarize the performance of each strategy. Download the code on OnePageCode Substack. The mean best Sharpe ratio indicates the average performance achieved by each optimizer, while the standard deviation provides a measure of consistency or robustness. A lower standard deviation suggests that the optimizer's performance is less sensitive to the initial conditions or random noise. This statistical summary is crucial for drawing reliable conclusions about the effectiveness of different optimization strategies in a quantitative trading context. Further considerations for practical applications. Visualizing GP posterior and acquisition function. While not directly implemented in the main loop for brevity, visualizing the Gaussian process posterior, mean, prediction, and credible interval, and the acquisition function over the search space after a few iterations provides invaluable intuition. This allows traders to see why the optimizer chooses certain points, observing how the GP model refines its uncertainty estimates and how the acquisition function guides the search towards promising or uncertain regions. For 2D problems, this can be done using code snippet or code snippet. Early stopping criteria. For real-world, expensive evaluations, it's often beneficial to implement early stopping. This could involve stopping the optimization if the improvement in the best observed value falls below a certain threshold for a specified number of consecutive iterations. The acquisition function's maximum value becomes negligible, indicating that no significant improvement is expected. A predefined budget of evaluations or time is exceeded. Incorporating trading constraints. In quantitative trading, objective functions are rarely purely mathematical. They often involve practical constraints. These could include transaction costs and slippage. The code snippet could be enhanced to account for these, making the Sharpe ratio evaluation more realistic. Minimum trade size/liquidity. Parameters might need to be constrained to ensure trades are feasible given market conditions. Risk limits. The objective function could be penalized if certain risk metrics, e.g., maximum drawdown, VAR, exceed predefined thresholds. These constraints and often be incorporated into the objective function itself, e.g., by returning a very low Sharpe ratio for invalid parameter sets, or by defining more complex search space bounds if supported by the optimizer. By understanding and implementing the sequential search process with various acquisition functions and conducting robust multi-trial analyses, quantitative traders can effectively apply Bayesian optimization to discover high-performing strategy parameters, leading to more profitable and stable trading systems. Revisiting Bayesian optimization for financial strategy tuning. Throughout this chapter, we have delved into the powerful framework of Bayesian optimization, BO, and its transformative application in fine-tuning parameters for quantitative trading strategies. Unlike traditional optimization methods, BO offers a sophisticated, model-based approach to finding optimal configurations for complex, often black box objective functions. Why Bayesian optimization? The challenges of optimizing financial trading strategies are manifold. 1. Black box functions. The performance of a trading strategy, e.g., Sharpe ratio, profit factor, is typically a black box function of its parameters. We can evaluate it by running a backtest, but we don't have an explicit mathematical formula, nor is it usually differentiable. 2. Computational expense. Each evaluation of the objective function, i.e., running a backtest for a given set of parameters, can be computationally intensive, especially for complex strategies or long historical data periods. 3. Noisy outcomes. Backtest results can be sensitive to market conditions, data quality, and even the start/endpoints, introducing noise into our objective function evaluations. 4. High dimensionality and nonconvexity. Trading strategies often have multiple interacting parameters, leading to high-dimensional search spaces. The performance landscape is rarely smooth or convex, making it prone to local optima. Traditional methods, like grid search rapidly, become unfeasible as the number of parameters or the granularity of the search increases due to the exponential growth in evaluations. Random search offers a better alternative for high-dimensional spaces, but still lacks the intelligence to learn from past evaluations. Gradient-based methods are often unsuitable because our objective function is not differentiable. Bayesian optimization addresses these challenges by operating in a sample-efficient manner. This means it strives to find a good optimum using significantly fewer evaluations compared to exhaustive or random approaches. It achieves this efficiency by building a probabilistic model of the objective function and intelligently deciding where to sample next. The exploitation imperative. A core concept underpinning the efficiency of Bayesian optimization, particularly through its acquisition functions, is the exploitation trade-off. Exploitation refers to sampling points in the parameter space where the model predicts high objective values, potentially refining a known good region. Exploration refers to sampling points where the model's prediction is uncertain, even if the mean prediction isn't currently the best. This helps discover potentially better, unexamined regions of the parameter space. Balancing these two aspects is crucial. Pure exploitation might lead to getting stuck in a local optimum, while pure exploration can be inefficient and waste evaluations on unpromising regions. Acquisition functions are designed precisely to navigate this trade-off. Core components revisited. The power of Bayesian optimization stems from the synergistic interaction of two primary components: the Gaussian process, GP, model, and acquisition functions. Gaussian processes, modeling uncertainty. As explored in previous sections, Gaussian processes serve as the surrogate model, or probabilistic model, for our unknown black box objective function. Unlike simpler regression models that only provide a point estimate, GPs provide a full probability distribution over possible function values at any given point in the parameter space. This is critical because it quantifies not just the expected performance, but also the uncertainty around that expectation. The GP model continuously updates its understanding of the objective function as more data points, parameter sets, and their corresponding performance metrics are observed. This allows it to learn the general shape and characteristics of the performance landscape, including regions of high and low uncertainty. Acquisition functions guiding the search. Acquisition functions leverage the information provided by the Gaussian process, both the mean prediction and the uncertainty, to propose the next best parameter set to evaluate. They translate the GP's probabilistic output into a utility score, guiding the optimization process. Two prominent acquisition functions we've encountered are expected improvement, EI this functi, prioritizes points that are expected to yield an improvement over the current best observed value, taking into account the uncertainty. It balances exploration, sampling where uncertainty is high, and exploitation, sampling where the mean is high. Upper confidence bound, UCB this function focuses on points with a high upper confidence bound, effectively combining the mean prediction with a scale measure of uncertainty. A higher scaling factor on uncertainty emphasizes exploration, while a lower one emphasizes exploitation. By maximizing the acquisition function, Bayesian optimization intelligently selects the next point to evaluate, moving efficiently towards the optimal parameters. The iterative optimization loop. The entire Bayesian optimization process unfolds as an iterative loop, continuously refining its understanding and search strategy. This iterative nature is a core programming concept underlying the algorithm. Conceptually, the loop proceeds as follows. Download the code on one patchcode Substack. This conceptual code illustrates the cyclical nature of Bayesian optimization. At each step, the model refines its understanding of the objective function, uses that understanding to propose the most promising or informative new point, evaluates that point, and incorporates the new data back into the model. This continuous learning and adaptation drive its efficiency. Case study recap. Pairs trading strategy optimization. The practical application demonstrate. D in this chapter involved optimizing the parameters of a pairs trading strategy. Specifically, we focused on tuning parameters such as the entry and exit thresholds for the cointegration residual, with the objective of maximizing the Sharpe ratio of the strategy's returns. This scenario perfectly highlights Bayesian optimization strengths. The Sharpe ratio calculation, derived from a backtest, acts as our black box objective function. We provide parameters, and it returns a single scalar value representing strategy performance. The backtest itself is computationally expensive, making sample efficiency paramount. The parameter space for thresholds can be continuous and nonlinear, benefiting from the GP's ability to model complex surfaces. By applying Bayesian optimization, we were able to efficiently navigate the parameter space, identify optimal or near-optimal thresholds, and ultimately enhance the profitability and risk-adjusted returns of our pairs trading strategy. This practical case study serves as a template for applying Bayesian optimization to a wide array of hyperparameter tuning problems in quantitative finance, from optimizing machine learning models for signal generation to fine-tuning execution algorithms.